It's not about where we've been. The markets are thinking about where we're headed.
The markets have kind of repriced very quickly any kind of risk premium.
There's clearly hesitation and a pause until we get clarity.
It's not smooth sailing from here.
There is some upside potential. That's why I think you've got the stock market sniffing this out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Stocks are down, Bramo's back. That makes sense, doesn't it? Welcome back, Lisa.
Wow, it's such a welcome. Thanks.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday as the Treasury Secretary makes his pitch.
America is the Schelling point of global finance. We have the world's reserve currency and the deepest and most liquid capital markets and the strongest property rights. For these reasons, the United States is the premier destination for international capital, and the administration's goal is to make it even more appealing for investors like you.
Investors and business leaders hoping that effort gets wrapped up soon. Ford, the latest company to suspend its full-year guidance as policy volatility takes a toll on forecasting. The Federal Reserve steps up next. A two-day meeting begins later this morning, concludes tomorrow, and Chair Powell can't wrap it up quickly enough.
There is this feeling that he should just say as little as possible at a time, where many people in the market are counting that later this year, the Federal Reserve will be forced to cut rates, and that'll be a positive. That is the bull case right now for a market that otherwise seems to, at least based on the zeitgeist this morning, seems to be embroiled in a bear market rally that has faded. And a lot of people are saying this is what to expect in this type of period.
The Treasury Secretary, the one to watch a little bit later on this afternoon, made his pitch to global investors yesterday. He's got to make his pitch to lawmakers later on today with one eye on the midterms.
That's right. And I think what you're going to hear from him today is almost similar to what you heard from him yesterday at the Milken Institute. I hope you can see the bigger picture now. That was his message. Everyone is focused on tariffs. You need to think about tariffs, the tax bill, and deregulation. And all of this three-legged stool when you look at the entire policy perspective of the Trump administration. But it's going to certainly be a grilling from some members who really want clarity on when these tariff trade deals are going to come into perspective. And also, when this tax bill actually gets done, what is going to be in it?
I wonder how diplomatic these lawmakers will be a little bit later at a time when corporate America is being very, very diplomatic. The Ford CEO, we should just all expect to be a little bit patient during this time to see how these policies kind of work out.
Diplomacy seems to be the word of the day, and when it comes to the McKinsey-isms of the CEO suite, there is this question, though, of what kind of pain and how quickly it would get really manifested at a time where there already has been a delay in some of the shipments. It wasn't just Ford, it was Mattel. Pretty much across the board, every single company that has reliance on China, but also just more broadly on global trade, is struggling for clarity. And I wonder for Scott Bessent, when he goes on the Hill today, it's not just going to be about what your ultimate goal is. It's going to be the path to get there at a time where everyone's saying we can get around your ideas, but we can't quite get around an execution that has been a bit rocky.
Could be quite a grilling down in Washington, D.C. Equity futures this morning, negative by 0.7%, adding to the losses from yesterday's session. Coming up this hour, we'll catch up with Cameron Dawson of Newedge Wealth on why the pain trade could still be higher. Tom Narayan of RBC as Ford pulls its outlook for the year. And Erik of Wells Fargo seeing tariffs weighing on U.S. exceptionalism. We begin this hour with stocks lower after snapping their longest winning streak in 2 decades. Cameron Dawson of Newedge Wealth writing institutional equity positioning remains underweight, suggesting that in the short term, we could still see the pain trade higher from here. Cameron joins us now for more. Cameron, good morning.
Good morning.
Let's just talk about where sentiment is. Everyone sounds very bearish. Are they actually short?
Well, we do see institutional equity positioning that is still underweight. And it's a great reminder that fundamentals do matter. And we do see the fundamentals deteriorating. But in the short run, if people are all very bearish and still underweight, you can see price diverge from fundamentals. So if you look at the Deutsche Bank consolidated positioning, even though we've had this 18% rally off the lows, it's still just in the 12th percentile. CTAs are still short, which just suggests that it doesn't take a lot of good news to see this market pain trade higher. However, we still do see the fundamentals deteriorating, which is why we think the risk reward is very unattractive to bet on stocks actually moving higher.
You're not alone. HSBC and Max Kettler out this morning saying the following. Forward-looking indications are for the hard day to feel the pain soon, perhaps already in the next month or two. This window, you've reflected on it. How big is this window before the pain hits?
It's a matter of weeks, we think, mostly when it comes to what we're seeing within transportation and inventories, what could impact small businesses, the fact that they can't get product to put on shelves, that you are in a very, very narrow window before we actually start feeling it as individual consumers, as small businesses wind down the inventories that they have been hoarding in order to get in front of this. We think that there still is this hope that the outcome, if the tariffs aren't reversed, would be so bad that they have to be reversed. However, we're not seeing a lot of progress, which just means that as this window narrowly closes, this is when we start talking about having more weakness within the hard data.
Do you feel like the right way to look at this moment is the bear market rally that we hear so many people talking about? Peter Oppenheimer of Goldman Sachs this morning coming out and saying, this is really typical. This is what you see, the massive bounce backs of, say, a 15% rally in big tech, normal.
Bring you back to March of 2022. March of 2022, we had a bear market rally of about 12%. It brought you back above your 200-day moving average, and you had this collective sigh of relief saying, it's all over, everything's fine. But what we think is likely to happen is that draws people back in. That's when you get positioning to snap back, and the end result is that creates an environment where you start to roll over again. So we do think that we are still in the midst of this volatility, that this volatility is not over because the fundamental volatility is not over, which just suggests that it's more of a head fake than necessarily the start of a brand new bull market.
So this raises a question if we learned anything over the past couple of weeks. And I'm not talking about this in an existential sense, that we could talk about that after the show. But I am wondering going forward about, have we learned something about big tech and about how they can lead during some of these rallies? Have we learned something about where the pain will be felt most? And have we learned something about the dollar and the fact that it has not participated in this overall potentially bear market rally?
So I think that to add to the big tech resilience of earnings, we have to also appreciate that when you start from a high starting point of valuation, you have more room to the downside, which is why big tech underperformed over the course of the sell-off. Now, of course, now that you've seen them deliver on the earnings front, you've seen a nice rebound, but we can't ignore the valuation side of things. The dollar is a very fascinating question because what we're seeing is a slight rebound in the dollar over the course of the past couple of days. And what we're also seeing is a very big short position in the dollar build. So we went from being max long at the start of the year to now being max short today. What kind of response do we get out of the dollar from that max short positioning? If it still trades down, it suggests that there's more fundamental selling versus just trading selling of the dollar.
Well, when it comes to the dollar, what do you make of the Treasury Secretary once again yesterday reiterating that the dollar is the reserve currency of the world?
Well, look, it would take a lot to unseat the U.S. dollar as the reserve currency of the world. It's the most liquid currency. It is what's traded, what things are priced in. However, prices matter and are set at the margin. And so what you're seeing in things like the Taiwan dollar skyrocketing higher because of less demand for U.S. dollars, this is a really interesting time to suggest of, at the margin, is there less demand for U.S. dollars? And what does that mean for the future of the dollar and the trajectory? And so we do still see it as the reserve currency, but it doesn't necessarily mean that that reserve currency can't go down in price.
A lot of the questions you put forward in your note are answered depending on policy. What if the genie goes completely back in the bottle and April 2nd, that huge chart the president brought in the Rose Garden, those tariff rates don't exist? What damage has been caused from April 2nd to now in the economy?
Well, I think the first question of damage is how much can you have faith that the policy path is predictable? So that is something that necessarily potentially raises the risk premium from there. Then the question is how much damage have you caused within supply chains, and what is the kind of recovery that takes in order to heal the supply chain damage over the past couple of months? It means that we could be getting into the fall and talking about the tariffs were just a bad dream. But then the question is do you get good policy on the other side to offset this negative policy from the tariff front? If the tariffs remain in place, we're not really sure if taxes are going to be able to fully offset the pain that the tariffs are causing, simply because it's just a baseline extension. So in a perfect world, the Rose Garden would have never happened, but the reality is it did.
The really good news is this hasn't morphed into a financial shock, Lisa. This could have been a whole lot worse.
And some people are pointing to the resilience of the U.S. economy and, frankly, of financial markets. But some of this is a testament to banks that are now saying that they are overregulated. But at the same time, how much are they the ballast of stability at a time where they are fortified and then some for any potential turmoil?
Markets can take on a life of their own. We say it all the time on this program. They can shape the events they anticipate. Does it bring you some comfort that financial conditions have eased somewhat over the last 10 days?
And don't forget that the MSCI EFA index, the non-U.S. international index, is at all-time highs. And so what we've been asking the question of, is the international market just being complacent? Is it ignoring the risks? Or is it saying that all of this concern about a U.S. recession, which we think would weigh on overall global growth, is just misplaced, meaning that the tariffs aren't going to cause the same kind of pain for the rest of the world? So we can't ignore that equity markets and credit markets are sending signs of calm, but we do think that there is a massive positioning aspect at play.
Another way of saying that is, are we whistling past the graveyard going into the next few months?
I was thinking of the same thing. We haven't seen the data deteriorate dramatically. If anything, it might have a stagflationary tilt. Yesterday's ISM services data seemed to suggest that. A bit better than expected and expansionary, but higher prices paid, the highest levels going back to January of 2023. When we start to see the actual pain, can we start talking about what the actual reaction to it is? Or is this a group of people who need to get, neurotically ahead of what's going to potentially happen when nobody knows anything? It's really fun.
There's always something to freak out about, including the economic data. You go to the ISM, I'm with you. Headline number, great.
Yeah.
But then prices paid, something to worry about. And that's been the data of the last week or so. GDP contracts for the first time since 22. Consumer confidence, ugly. At the same time, payrolls were pretty resilient. I can do the same with corporates. We mentioned Mattel, we mentioned Ford pulling their guidance. Visa's pretty good. They say everything is absolutely fine. What are the companies saying from your standpoint?
And look at first quarter earnings, which were expected to come in at 8%, are now coming in at 12.8% for the first quarter. But we think the first quarter is very backward looking, which means that as we start getting into 2Q, all of that pull forward dynamic starts to fade. And we think that starting in the May data, you will start to see signs of weakness within the most hard hit areas: transportation and logistics, travel and leisure. This is where you're going to start seeing the fraying. And what we think companies are going to start talking about is the potential for margin pressure. And the question is, how do you respond to margin pressure? Do you start laying off workers? Do you stop investing in your business? That's how this becomes something that's contained to something that is a much broader economic issue.
That's the ugly question potentially for later on in the summer, that's for sure. Cameron Dawson of Newedge Wealth is going to be sticking with us. Equity futures on the S&P negative here by 0.7%, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. Ford shares are falling 2.3% in the pre-market after it suspended full-year guidance and warned Trump's auto tariffs will hit profit. The automaker said the duties would cost it $1.5 billion in adjusted earnings before interest and taxes. Still, Ford's tariff exposure is less than its rivals since it produces 80% of the cars it sells in the U.S. domestically. Meanwhile, Germany's Friedrich Merz failed to secure a majority vote to confirm him as the next chancellor, preventing his swearing in today. This is the first time since World War II that an incoming chancellor failed to get parliamentary backing in the first round of voting. German lawmakers will not vote again today. And DoorDash reached a deal to buy UK-based food delivery platform Deliveroo for $3.9 billion. DoorDash, which already controls 2/3 of the U.S. food delivery market, will now expand its reach to more than 40 countries. The two companies combined had a gross order value of about $90 billion last year and 50 million monthly active users. That's Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, defending the Trump agenda.
Getting better terms of trade, it's not always a pleasant process, but I think at the end, the trading relationships will be stronger.
Up next on the program, we'll catch up with Tyler Kendall down in Washington, D.C., and we'll have more from Cameron Dawson from New York City this morning. Good morning. Snapped a 9-day winning streak on the S&P 500 in yesterday's session, just a touch softer on the benchmark. Again this morning, we roll over by 0.7%. On the Nasdaq, we're down by 0.9. Under surveillance this morning, defending the Trump agenda.
Getting better terms of trade is not always a straight line. It's not always a pleasant process, but I think at the end, the trading relationships will be stronger. Our security and values ties will still be there.
So here's the latest this morning. The Treasury Secretary, Scott Bessent, heading to Capitol Hill today, continuing to push the president's fiscal and economic policies. Joining us now from the nation's capital, Tyler Kendall. Tyler, go through the agenda for us. What's at the very top?
Yeah. Hey, John. Good morning. Well, we should note that today's hearing is just one of two back-to-back hearings that the Treasury Secretary is going to have on Capitol Hill this week. Today's is in front of the House Appropriations Committee. It's going to be a subcommittee. It's going to be a smaller, more intimate hearing, perhaps. And it has to do with oversight and the Treasury Department's fiscal year 2026 budget request. So today, expect things like the IRS cuts related to DOGE to really be at the forefront of the conversation. But that doesn't mean that lawmakers are going to miss their chance to grill the Treasury Secretary when it comes to tariffs and also, of course, the reconciliation package, as the Treasury Secretary really is the one at the forefront of this administration's efforts to try to calm both consumers and investors' concerns alike when it comes to the White House's economic agenda. And he really has been making clear in recent days that he wants everyone to look beyond just the trade agenda, but also focus in on reconciliation, those tax cuts, and deregulation, two things that he really actually needs Congress to fully implement. At the end of the day, we heard him try to make that case yesterday at Milken. That doesn't necessarily mean he's going to get as warm a welcome on Capitol Hill later today when he does face those lawmakers. And that's because there's at least one member of the House Freedom Caucus that is on that subcommittee that's going to be grilling him today. And we know that one of the priorities for these more fiscal hawks is that they want to see deeper spending cut commitments from this White House when it comes to reconciliation to offset that tax cut agenda. And I bring that up because that is perhaps one of the biggest impediments this White House is facing to get done its reconciliation package. And quickly, John, of course, though, the Treasury Secretary going to be on Capitol Hill again tomorrow. That's in front of the House Financial Services Committee for a full committee hearing that's going to be much longer and is considered to be his annual testimony to Congress.
A dual grueling between today and tomorrow for the Treasury Secretary. We're also going to have the president sitting down with the Prime Minister of Canada, the new Prime Minister, Mark Carney. This is the president yesterday said trade deals, Tyler, are within the next 2 weeks. Who's on top of the list?
Yeah, Annmarie. Well, it's definitely not Canada, particularly that the Commerce Secretary, Howard Lutnick, in an interview yesterday did not express optimism that a trade deal is close when it comes to Canada, saying instead that today's meeting will be fascinating, but he doesn't think that they're close to any sort of agreement there. When it does come to who could be close, and of course we're watching closely with bated breath on if we get any sort of these framework agreements, we've been really zeroing in on those countries that this White House has told us before that they are prioritizing, those Asian economies that are geographically close to China, including South Korea, Japan, and also India, who yesterday pledged to drop tariffs down to zero on a reciprocal basis on a range of goods, including metals, autos, and pharmaceuticals. As this administration yesterday, in fact, President Trump saying that in the next 2 weeks, we could expect pharmaceutical sector-specific tariffs to go into place. Of course, that is no surprise. The administration did launch its Section 232 investigation into this back on April 1st, but typically those take about 9 months to implement and conclude. It's clear that the administration is pushing forward with those on a much quicker basis.
Tyler Kendall, thank you. With the latest down in Washington, D.C., the president knows how to do TV. Carney, Trump in the Oval. Must watch a little bit later, right?
Yeah, I think it's going to be pay-per-view viewing because he has been trolling Canada since he was elected, talking about being the 51st state. Although he has said nicer things about Mark Carney than he'd do the former Prime Minister, Justin Trudeau. So maybe there'll be a little bit more of, I don't know, je ne sais quoi for Mr. Carney. But he still talks about, as he did this weekend, Canada becoming the 51st state.
Cameron Dawson says we can learn things from the Spice Girls. This is what she writes in a note over the weekend. Any fool can see they're fooling. Nice work over the weekend. I was impressed.
Thanks.
Anything else to learn from the Spice Girls?
Oh, goodness. Well, look, we do think that the Spice Girls do set up this interesting prospect for the market where the market is really wanting the Trump administration to back off from tariffs and that there's this hope that they will be there. Say you will be there to back off from trade and tariffs because as you're pricing in a 20.5 multiple, if you're looking at the high yield spread being at just 350 basis points. There's a lot riding on Trump backing off from these tariffs.
Too much of something is bad enough, right? Too much of nothing is just as tough.
I'm so impressed.
How do these talks end up?
We don't think that they get completely reversed. And we do think that tariffs do remain in place because we've seen Trump talk about tariffs playing a role of raising revenue. If this was just a negotiating tool, you would certainly see them backing off from the idea that this could be a way to pay for income tax cuts in other places.
When it comes to trade, though, obviously China is the #1 deal that everyone is looking at for any sort of smoke signals if we're going to get there. I can also play this game, Jonathan. Well, does Xi Jinping want to be at the table with Trump?
We don't think so in the very near term. We've seen so little progress. Now, we do know at 145% tariffs, this is completely a halting on trade, which is not sustainable. So we do think that the tariff eventually moves lower, but there is so much optimism that we are going to get to 60% tariffs and we're going to get there soon, that we think that that's probably too optimistic and that we could be in this position where tariffs remain higher for longer than what consensus is expecting.
You're saying 60% tariffs on China is too optimistic when a lot of analysts would say that's still almost a trade embargo between these two economies. Is that how you view it?
Well, we do think that 60% is still so onerous that it is effectively still a trade embargo. But we're hearing more and more from consensus that will ratchet this down from 145% to 60%. You'll have some breathing room. Maybe you'll get a little bit of trade coming back. And that's where we're just less optimistic that you're going to get that within that narrow weeks of closing windows.
Yeah, if you want to be my lover, you got to be with my friends. You know, I mean, that's part of the issue.
There we go. We're keeping
I mean,
this
honestly,
up.
okay, this is ridiculous.
Nice.
All right, no, just to shift this back.
Do you want to be 30 years old next year? You want to feel really old? 30 years next year.
Thanks, John. Thanks. That makes me feel, warm and fuzzy
29
inside.
next month.
All right, we're talking about tariffs.
Crazy.
Hold on a second.
I feel old now.
So here's a question that I have. And Julian Emanuel of Evercore ISI put this out, and I thought that it was really interesting. He said, because the markets were going up so much, it gave President Trump the open window to have tougher talk on trade. And sure enough, the next day, all of a sudden, we start hearing about 100% tariff on all films that aren't made in America, as well as potentially some additional tariffs to be announced on pharmaceuticals. Do you agree with that thesis?
Yeah, definitely. We think that a rallying market easing financial conditions allows Trump to spice up our life with more tariff announcements. And certainly it gives him the wiggle room to be able to add on further tariffs, which just means that if we see markets correct, then that's when we see him back off. If we see yields back up, that's when we see him back off. But if you have rallying markets and a subdued bond market, expect more tariff headlines.
I can't. I'm looking at lyrics. I'm thinking about the fact that I'm old. I mean, John, please, come on.
I feel like I need to explain this.
Yeah, please do.
If you're tuning in and wondering what is going on, Cameron Dawson every weekend puts out a note on a Saturday morning, very, very early at about 7 a.m. Eastern time. And in that note reflects on some lyrics from any given band. And the dare from me was, can you do it for the Spice Girls?
Right.
And she put out this wonderful market note over the weekend with just Spice Girl lyrics after Spice Girl lyrics.
But I believe that there was another part of that agreement.
Yeah, the dare was that I had to say girl power. Now,
Is that what's going to count?
I think that counts.
Oh, Cameron wants to see.
John is a Spice Girl fan.
I love the Spice Girls. Yeah.
So this note is perfect for
I'm haunted from when I was a kid and used to go over to Europe, to the continent in the 90s, and all the kids would run up to you and go, and then they'd put their hands up.
What do they
do the girl power impression.
So
just because they heard an English accent.
You're still a little bit traumatized. But actually, if you look at the Spice Girls lyrics, it was really kind of getting ahead of the moment that we're in, because they all could be applicable. It's like a horoscope.
Nice. All right, Cameron, you can run. Cameron Dawson. Have I completed my end of the bargain? I think I have.
Very well.
Just about. OK. Cameron Dawson of Newedge Wealth. Cameron, thank you. There's serious matters to deal with today. The Treasury Secretary on Capitol Hill a little bit later on, and again tomorrow, facing down the House. And I think some serious questions coming from lawmakers. We reflected on this just briefly. Lawmakers who have constituents who they have to face going into the midterms next year. And when the Treasury Secretary approaches investors over at the Milken Global Conference and says to them, basically, trust us, our platform will be pro-growth, it will be pro-risk. These lawmakers have got their jobs on the line. And you're going to hear those voices get louder and louder over the months to come.
At a time when they're being tasked with crossing some red lines for them in terms of potentially cuts to certain benefit plans like Medicare and Medicaid, and potentially expanding the deficit. And that is the battle that Secretary Besson's going to have to fight.
Just about got through that segment, I'm pleased to say. Coming up, Tom Narayan of RBC. as Ford pulls its full-year guidance. Just about. From New York City this morning. Good morning to you all. You're watching Bloomberg TV. Live from New York City this morning. Good morning and welcome to the program. Equity futures just a touch softer. We're down by 0.7% on the S&P. On the Nasdaq 100, down about 1 full percentage point. With 3 hours until the opening bell with your morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. A really painful pre-market session thus far for Palantir, down 9%. The company reported earnings yesterday and it rose guidance. It talked about a ravenous whirlwind. That's the exact phrase they used, coming from AI demand. That wasn't enough for investors. Maybe it has to do with the fact that this is the best performing stock so far this year in the S&P, up 64%. So expectations were high in rest of world demand. That was a little bit softer. Also disappointing on its earnings yesterday after the bell was Vertex Pharmaceuticals. They missed basically on most of their metrics. Shares are down some 5%. The task ahead for them, diversify their portfolio. They're trying to get away from dependence on opioids, but it's not quite there yet. It has a new drug in the market, but BMO basically saying that they're giving it away for free at this moment, and they said that they wouldn't get the results in this quarter or next quarter from that new drug. Finally, wrapping things up with Ford this morning. The other big earnings after the bell yesterday, another automaker, another pulled guidance. We got the contours of the hit from tariff. They said it will net out to $1.5 billion. That's not as bad as GM, for example, which is about $5 billion, because, of course, Ford does produce more of its vehicles that it sells into the U.S. domestically, about 80%. Even so, those shares down more than 2%, John.
Hey, Danny, thank you. Appreciate the update. More on Ford in just a moment. On our radar this morning, President Trump saying China wants to make a trade deal, quote, very badly. This coming as he's set to meet with the Canadian Prime Minister Mark Carney later on today.
And over the weekend, when he was asked about this meeting between the new Prime Minister, he talked about the fact that he wants to come see me, not really sure why. He probably wants to make a deal. Everyone wants to make a deal. And then he also went through a ton of grievances he has with Canada and the fact that Canada needs the United States more than the United States needs Canada. I think, honestly, I'm not trying to be funny. I think today a litmus test is whether or not he will call the Prime Minister governor the way he used to call Trudeau a governor. This is someone maybe he can work with. We need to remember and remind our audience the reason why Mark Carney has this job partially is because of Donald Trump.
The president turned that election upside down. We need to figure out what policies are going to look like, and the California governor, Gavin Newsom, is facing the same issue. He's calling for federal tax credits of at least $7.5 billion to attract more filmmaking to the United States. Newsom suggesting a partnership with the administration after the president proposed tariffs on foreign-made movies.
Okay, this is such a fascinating story on so many different levels because Gavin Newsom has been trying to play this whole Trump wave in a very unique way in terms of how he's talked with Joe Rogan, how he's sort of trying to angle this. We're eager to partner with the Trump administration to make American film again rather than make Hollywood great again, which is what President Trump said. Look, he's trying to take advantage, Governor Newsom, of this proposal by saying, okay, help us out. Give us a sweetener on the other side when it's clear that this administration is loath to do so, given the divide between blue and red states.
The concern after the weekend beyond just that, I think a concern that the tariffs might stretch beyond goods and go to services. And that's a new wrinkle in this story.
Absolutely. And people are trying to understand what exactly does this mean and how would you implement 100% tariff on movies not being made or being filmed foreign and outside of the United States. What is so interesting is that Trump yesterday said, we're going to meet with the industry. I want to make sure they're happy with it because we're all about jobs. I think he's taking a maximalist approach and he's going to dial it down because the actors that met with him over the weekend were talking about tax credits, and then Trump came out with tariffs. So maybe we're going to meet somewhere in between.
Netflix stock got shaken up big time in the session just yesterday, and then things settled down going into the close. Elsewhere, in Germany, the Chancellor Friedrich Merz, the incoming Chancellor, I should say, falling short of a majority vote in Parliament. It's the first time since World War II an incoming Chancellor failed to get backing in the first round of voting. Sources telling Bloomberg there won't be another vote today. Joining us now is Bloomberg's Ollie Crook from the Bundestag. Ollie, let's talk about this. It's embarrassing, without a doubt. Does this delay the inevitable, or does it derail it?
Yeah, listen, I think that the sort of base case is that it delays the inevitable, but it is also a massive political signal. And I think that really for everybody who's been observing this election, everybody who'd been sort of planning our coverage going into it, no one really expected this to happen. This was supposed to be the rubber stamp day where you begin with a vote in Parliament and then you go through some nice procedures. You have a sort of swearing in from the president of the chancellor. Then you have the transfer of power from Olaf Scholz to Friedrich Merz. That is not the day that occurred here today, where you had a failure at the very first step, where you did not even get all of the lawmakers within the coalition voting for the chancellor. And as you say, Jonathan, this is without precedent in modern German history. So no one really knew what would come next. We all broke out our German constitutions reading Article 63 to understand that basically now there's a 14-day window in which there may be more votes. Initially, it was said that there could not be another vote today. Then there was some ambiguity around that. There certainly will be additional votes in the coming days. The base case, John, is that they're going to get this through, that the chancellor will be, that Friedrich Merz will become the next chancellor of Germany. But it throws into question a great number of things. When you think about the fact that you cannot even get the chancellor candidate through, a chancellor candidate, which, by the way, it took 6 months from the dissolution of the government in order to get to the stage to that vote, couldn't even get it through. How are you going to agree on spending €1 trillion worth of assets? How are you going to agree on uniting the whole country and dealing with the troubles that are brought by the Trump administration, immigration, and all the litany of other issues that Germany is dealing with?
Oliver, what if a second vote also fails?
So listen, we are looking now at this Article 63 in the Constitution. So you can have a number of different votes over the coming days. If those all fails, you can have a sort of another sort of further set of votes. But at a certain point, if those all fail, what you have is the president will either just make a decision, say appoint somebody chancellor, or you might have another election. And that is extremely interesting in the context of what's happening domestically here in Germany, where you have in the last few weeks the AfD, the right-wing party within Germany, the one that wants to leave the Eurozone, the one that wants to get rid of sort of a lot of immigrants and is very sort of anti-Islam, has basically been polling #1 in the country. It has overtaken the CDU in many of the polls, adding to the fact that just 4 days ago, that party was ruled an extremist party by the internal sort of intelligence agency, saying that they are an extremist party and that they are now allowed to be surveilled, a fact that Marco Rubio was running with and saying that basically now the German government has deployed a spying agency against their main opposition. So that is the political context behind all of this. So things are getting very, very interesting here in Germany. We'll have to see how it plays out over the next few days. Again, the base case is that Friedrich Merz will be able to get in, but in a world of non-zero chances and non-zero outcomes in the political establishment around the world and in Germany, it's something that we cannot really rule out.
Let's say that the base case does come to fruition, where Friedrich Merz does become chancellor. Does this make it that much more difficult that Germany can pass a spending package that a lot of people have expected was basically a fait accompli?
Absolutely. I think that is going to be the next conversation. If you can't even agree on the leader of the coalition that you had already agreed to, and they signed their coalition agreement yesterday, then how are you going to have these agreements in terms of €1 trillion worth of spending? What I think is interesting is that, the idea here was that we're going to get over a lot of our political difficulties in Germany, a lot of our disagreements by basically debt financing a lot of these issues, throwing money at infrastructure, throwing money at defense, throwing money all over the place in order to basically paper over a lot of the political concerns. That has not worked. And so I think that these sort of live debates in terms of where the money is going to be spent, to say nothing of the other debates on immigration and how that sort of progresses, are still very much well alive here in Germany, and the degree to which I don't think people realized until this vote this morning.
Ollie, appreciate it. The latest over in Germany. If we get any more headlines, we'll bring them to you, and hopefully we can catch up with Ollie Krug out of Berlin. Let's turn to the autos. A lot to talk about there. Ford shares sliding after the company suspended its full-year guidance, seeing a $1.5 billion hit from President Trump's tariffs. Tom Narayan of RBC writing, Ford's Q1 was better than expected but still challenged. A weaker than expected macro environment could result in increased pricing pressure and lower than expected financial results. Tom Narayan joins us now for more. Tom, let's get to that $1.5 billion hit. How do they come up with a number like that one?
Yeah, so it's actually interesting. It's a similar number actually to GM if you just look at the U.S. exposure. So it's a $2.5 billion gross number. That's the tariff impact that they face, Ford does. Then they said there's about $1 billion of demand dynamics, which they didn't get into a lot of detail on. But basically, it's things like offsets like pricing adjustments, the fact that their nameplates may be more advantaged than their competitors, and that nets out to this $1.5 billion tariff hit. But just as a reminder, that's when you assume that basically they assume the tariff. as opposed to passing it on to you and I. Something similar to what GM said in their number. Theirs was much bigger, 4 to 5 billion, but in GM's case, 2 billion of that came from Korean imports. And then they said they have some offsets, about 30% of the U.S. stuff. Basically, they can offset through shifting production to the U.S., et cetera, and netting out to something similar, like 1.15 billion. So we found it really interesting that the Ford exposure in the U.S. and the GM exposure to the U.S. was actually similar. There was a narrative that Ford was advantaged more than GM, but as it turned out, and I think that could be why the stock is trading lower now, pre-market for Ford, that it may be a similar exposure if you exclude the Korean imports that come in for GM.
So, Tom, this is important when it comes to things like their approach to pricing. Tom, and I just wonder what this will mean going forward.
Yeah, I mean, it's very likely you're going to see higher pricing. In fact, Ford even said that their new guidance assumes higher pricing for the back half of the year that nets out to being flat. GM said something very similar. One thing that's up for debate is, will certain OEMs eat the tariff on certain cases, because it may actually be more economical to do so and to gain market share, right? And then other OEMs, will they just pass it on instead of doing that? Because obviously the decremental margins are much less than if you just eat the tariff. So we'll have some interesting movements and gyrations, I think, in market share in the back half of the year. But ultimately, I think it's safe to say we're going to have higher pricing.
Let's build on this, Tom, and I'm glad that John brought it up, because Ford, I believe, was the one that came out and said that they will determine how much they need to raise prices based on what their competitors do, how much they raise prices. Who do you think is going to be the first mover in adjusting prices upwards and testing the market to determine just how much wiggle room they have?
Yeah, I think, interestingly, it'll be the companies that are most able to do it, right? The one that has the less price-sensitive customer. If you're GM, right, 65 to 70% market share of large SUVs, those customers buy, they're less price-sensitive. That's why GM's margins are so much higher. They can probably afford to price higher, and the consumers will still buy those products. It's hard to tell. And also inventory levels. GM has lower dealer inventory levels, so they can afford to kind of play with pricing more so than, let's say, Ford or Stellantis, who have higher dealer inventories. Also, the other problem you have, like Stellantis, the pricing is very high, right? If you compare it to 2019 pre-pandemic levels, it's up very high, and pricing has been falling. It's harder for them to push pricing higher. So probably a name with more health, less price sensitive customer base, they can do it. In the Europe side, the premium guys like a Mercedes or what have you will definitely try to price, right? Because that's a less price sensitive customer.
Tom, on Ford, I know they're waiting to see if they can receive the credits for the U.S. content in vehicles that they import from Mexico. How important is that for the company?
Yeah, it definitely is. I will say, though, that the last week's announcement on Tuesday with the offset that the administration allowed, the 3.75% of MSRP, I think is indicative of where the industry is going. I don't want to sound like overly negative here on the tariff situation. The reality is last week was a very positive week for the auto industry on tariffs. You also got the supplier kind of clarity that USMCA status would continue to be exempt for the parts. So it's looking more constructive, I will say, but anything can change, as we're noticing. You guys were saying earlier, if the market moves up, we may get more negative news on tariffs. So it's an evolving space, but certainly things are getting more constructive.
It can change again this afternoon. Tom, appreciate the input. Tom Narayan there of RBC on the latest with the autos. It can change any second, which makes it very, very difficult to plan as a business leader.
I actually think that the meeting today with Mark Carney of Canada is going to be really crucial for these car makers. And this is the reason why. What's the tone? Does the president want this to seem conciliatory and if you come and join us, we're going to make it nice for you. We're not going to embarrass you. Or is this going to really raise a specter that that's not on the table? That, to me, I think is going to be a big test for these auto manufacturers.
And I wonder if they put out the red line of we're basically just trying to renegotiate USMCA and get better deals. That's up for renegotiating at the start of next year. Tom there was like, I don't want to say it's negative. I don't want to say it's optimistic. The CEO of Ford says it's dynamic. It's a dynamic situation, and I need patience right now because they're waiting for answers the same way we all are as well.
The Canadian Prime Minister sitting down with the President of the United States later on this afternoon with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. The Trump administration is looking to thin the ranks at the highest levels of the military. Defense Secretary Pete Hegseth is ordering a 20% reduction in 4-star positions and at least a 10% cut to generals and admirals. Hegseth called it less generals, more GI policy in a social media post. Congress has to approve any changes to military command. Meanwhile, Mattel, the toy maker behind Barbie and Hot Wheels, withdrew its forecast for a return to sales growth this year, citing President Trump's tariffs on imported toys. Mattel makes nearly 40% of its products in China. The company said it plans to raise prices on some toys and diversify its supply chain to try and offset the impact of tariffs. And the Department of Education resumed collections on defaulted student loans yesterday. Collections had been paused since March of 2020 due to the pandemic. The restart is expected to impact roughly 5.3 million borrowers, putting them at risk of having their wages garnished if they don't make payments. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the programme, Secretary Bessent makes his push.
The United States is the premier destination for international capital, and the administration's goal is to make it even more appealing for investors like you.
That conversation up next with Erik Nelson of Wells Fargo, live from New York City. You're watching Bloomberg TV. Taking the temperature down in the equity market, we're negative by 0.6% on the S&P 500, on the Nasdaq down by 0.9, the Russell, the small caps negative by 0.8. Under surveillance this morning, Secretary Bessent addressing global investors.
America is the Schelling point of global finance. We have the world's reserve currency and the deepest and most liquid capital markets and the strongest property rights. For these reasons, the United States is the premier destination for international capital, and the administration's goal is to make it even more appealing for investors like you.
So here's the latest this morning. The Treasury Secretary Scott Bessent looking to assure global investors. Erik Nelson of Wells Fargo has this to say. Disruptive policies are likely to weigh on productivity and U.S. exceptionalism, implying a structural dollar negative. Erik joins us now for more. Erik, good morning. It's good to see you, sir. You travel the world, spend a lot of time in Europe. How are they looking at U.S. assets now compared to how they looked at them just a number of months ago?
Yeah, it's a very different story, not just in Europe, but I think, across Asia. And there's two things here. I think one is, if you're overweight, significantly overweight U.S. assets, maybe you have 75% allocation, you're probably over the next few months looking to take that down a little bit. Where you weren't hedged to nearly the extent you maybe should have been, you want to increase those hedge ratios. Question for us is, how long does this story take to play out? The move in Taiwan in the last couple of days has certainly attracted a lot of attention. I don't know how much of that is really genuinely the insurers in the region really increasing hedge ratios significantly, as much as it is, stop outs among hedge funds and, a lot of technical short-term factors. I think the hedge ratio stuff comes over time. It's just these people don't move very quickly, right? So it's a multi-month, multi-quarter story, not a multi-day story.
You're referring to the Taiwanese dollar, which has absolutely skyrocketed over the past couple of days on speculation that maybe life insurers that had a lot of their assets in dollar-denominated securities were trying to hedge some of that exposure, and there would be this allowance of a weakening in the Taiwanese dollar to ease some of the trade discussions. Putting all of that aside, how many more potholes, how many more extreme moves can we expect like the Taiwanese dollar?
Well, Taiwan, I will say, is exceptionally unique in terms of the dollar exposure. You're talking about 30-40% of GDP in terms of dollar deposits, almost bordering on full-on dollarization. It's hard to see something else in the region that's quite of that same extent. I mean, Chinese exporters are certainly another place to look where you could see more pressure, but not the kind of 10% move in multiple days. I think we have to be careful extrapolating here from Taiwan for that reason. It kind of reminds me when we see an RBNZ meeting and they talk about something and people say, oh, that means something for the Fed. Like, let's just back off a little bit here. So I do think that the market does need to, process these sorts of things. And look, I think, the point on sort of the CBC and their sort of hesitancy to step in here is also a really important one. Typically you would definitely see the central bank step up and offset this move at least. But the challenge around sort of intervention and the optics of that right now is a real factor.
All the Taiwanese dollar supporters and exciters can really write their mail to Erik Nelson. That is his private opinions, not necessarily ours. I am wondering, though, if there is a sort of counterintuitive aspect to the dollar weakening. And we're seeing this in some of the earnings calls of corporate America, where this is actually a tailwind for them. This is actually a desired outcome. And a lot of people have been saying this will add to the strength of the United States economy. At what point is that a boost to GDP in the U.S., not necessarily a detractor?
Yeah, we've had this exact conversation with a ton of corporates. So the mentality, sort of earlier in the year was, as euro was falling, all these FX were falling, why is our hedge ratio not higher? And now all of a sudden it's, hang on, we've seen the dollar go down when equities have gone down. Let's participate in this. We don't want to cut off tailwinds. So it's a completely different conversation. And I think, looking out, and certainly the Mag 7 are no stranger to dollar exposure and the importance of that in driving earnings. So yeah, that could be something that over time becomes positive. But I think the bigger thing, again, over multiple years when you see dollar downtrend is, emerging markets tend to do relatively well in that environment. There's still a lot of global growth hurdles out there, but that's certainly long-term, probably where investors are going to start to look.
Erik, we just had the chancellor this morning lose a vote in Germany, soon to be chancellor, not quite yet. When you hear the administration talk about trade deals, Europe barely gets mentioned. Where do you see the outlook for euro dollar?
Well, right now, tactically, we think it goes lower. Right, so positioning has gone a long way in a very short space of time. Exuberance has certainly picked up quite a bit. The fiscal tailwinds that are coming in Germany aren't coming immediately. And I'm not super worried about necessarily a full-on collapse in Germany's government. But it does remind investors, I think, that if you want to de-risk from the U.S., there's not some amazing oasis of place to park your money. China, Europe, they all have their respective structural issues. Germany will get through this. We'll put this behind us, but I think it is a bit of a stark reminder that if you want to really reduce U.S. exposure, it's not an obvious place to go.
What is the obvious place to go?
Well, I think there's certainly going to be more of a home bias. So Canada is a great example of this. You think about so repatriation. Repatriation is, I think, in Japan, Canada, that sort of thing can certainly come over time. The pension funds, there's been a lot of rhetoric on that for Canadian pensions. I think as JGB market starts to calm down a little bit, Japanese lifers will start to move back into JGBs. There is more of a home bias, I think, over time.
Does that speak to the Taiwan move?
Well, yeah, I think Taiwan, the dollar exposure, the lack of hedging was just so extreme, and I think there was a realization, that this day could come, right? And it was a matter of, it's a classic musical chairs situation, right? While the music's playing, you got to keep dancing. So I do think that this will broadly, again, over the next several quarters, make people think twice about, oh, I can just park money in the U.S. and if things go wrong, the dollar's going to strengthen.
Yep.
That lack of that breakdown and that correlation, I think, will really, like it has for corporates, change the mind of investors.
That's a major shift, that's for sure. It's good to see you, sir. Thank you. Erik Nelson there of Wells Fargo. We're still dancing. It's just bloody exhausting, isn't it? It really is.
Well, it's exhausting, especially at a time where there's such a lack of clarity. I think Erik's point, though, is really well taken, which is when you have people who have counted on the dollar acting as a hedge against the U.S. assets that they buy, that is no longer instated. Maybe it's not necessarily going to portend other currencies. Maybe it's like the, the New Zealand situation, but it is interesting.
Shade at the RBNZ, eh? It's like macro shade, brutal. Coming up next, Sarah Hunt of Alpine Saxon Woods, Bloomberg's Tyler Kendall, Congressman French Hill, and Jonathan Pingle of UBS. The second hour of Bloomberg Surveillance. Up next.
The Fed's got to be really concerned about a whole range of issues.
There's a real secular risk of a second wave of inflation here.
There's momentum in this economy. The question just is, will this momentum be strong enough to get us through?
It puts the Fed in a tremendously difficult position.
There's no reason for the Fed to be cutting or signaling that they're going to be cutting anytime soon.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. Hello, everybody. Your equity market looks like this. Equity futures on the S&P 500 negative by 0.5%, just a little bit softer, both on the Nasdaq and on the S&P 500. The Nasdaq down by 0.8. Your week ahead shaping up as follows. Two things to watch today. Two very important meetings. Treasury Secretary Scott Bessent on Capitol Hill meeting with House lawmakers. Look out for that a little bit later. Then after that, you're going to see a sit-down conversation with the President of the United States and the Prime Minister of Canada, Mark Carney, Donald Trump, in Washington, D.C.
Key question isn't necessarily what trade issues are going to be perpetrated after that or discussed, but rather the tone. The body language, how much there is a conciliatory, warm welcome or versus some sort of Zelensky repeat where there are these awkward sort of confrontational aspects to it. It is important to understand, A, exactly whether there could be some sort of agreement, and B, whether this is an olive branch to the rest of the world. If you come to us and discuss it, we will treat you kindly.
And the president said it's Mark Carney that wanted to have this meeting. He said he thinks he's a nice guy. He probably wants to come and have a deal. I think a lot of today, the framing will be about what does this mean in the months to come when it comes to USMCA, how much they really want to renegotiate and get more concessions out of Canada and Mexico when it comes to USMCA. And on the international front, remember, Prime Minister Mark Carney will be the one playing host to the G7 next month. So this could be almost the preview to what we can expect when Trump meets other world leaders at that G7.
Let's unpack that. Let's run with one thing, USMCA. When I think of USMCA, I think of one thing, not music, I think of this, the auto sector, the auto industry. That for me is front and center for that conversation later on, after a day where we saw another company, this time Ford, suspending its guidance.
Amid dynamic trade policy. It is very dynamic because it could go either way. On one hand, you could end up with these tariffs and blockades that increase the cost of production for the likes of Ford, or you could end up with a new trade deal that actually reduces some of the frictions between the two countries. Look, we don't know how this is going to come out. That's the reason why I actually think this is one of the more important meetings to happen at the White House.
Because when you look at autos, sometimes a single car can go across the Canadian border back into the United States 7-8 times. That is why the auto sector and the integration of the supply chain between Mexico, Canada, and the United States is so important. And then you have individuals like the Ford CEO saying, we've been very clear with the government about the flexibility we need. Will they get any sort of indication that this administration is willing to be more flexible today?
Equity futures right now recovering somewhat. We're negative by 0.5%. Coming up this hour, we'll catch up with Sarah Hunt of Alpine, Saxon & Woods as stocks snap a historic winning streak. Congressman French Hill with Treasury Secretary Scott Bessent set to testify on Capitol Hill, and Jonathan Pingle of UBS on the Fed's growth and inflation trade-off. We begin this hour with stocks lower after snapping a 9-day winning streak. Sarah Hunt of Alpine, Saxon & Woods writing, it may take a couple of months to see the real-world effect of the trading slowdown caused by the tariff situation. It's hard to believe this all started only 4 weeks ago. Sarah, good morning.
Good morning.
I said the same thing yesterday. Where's a month gone? This has been brutal, hasn't it?
It has been quite a lot to happen in a short period of time. And I think, I've talked about this before. I think market participants are so used to immediate effects and immediate information flow that we don't all remember that this all takes time to play out through the economy. So this only started 4 weeks ago. The actual effects of that are not even close to being seen. And all you're seeing right now is the ancillary effects that people are worried about.
Equity markets have recovered at the index level on the S&P 500. Policies haven't changed too much. What kind of changes are people expecting and how quickly?
Well, I think this is the big question, right? So you had a really decent earnings season for the most part. You had a number of companies call out the problems. You had a number of issues, but the CapEx was strong. The AI story stays intact. That was very helpful, I think, for markets, and that was very important. But now we get back to, okay, now what's going to happen in trade, and we still don't know. And I think that is, the sooner we can get any kind of clarity on that, the better. But right now, I think that just leaves us in a tough position risk-reward-wise.
If someone were on the U.S. central bank, they might be really happy that we have so rarely mentioned the Fed on a day when the two-day meeting is starting, and they do have to come out with some prognostications tomorrow. I am wondering how much of a possible put this is later in the year if the Fed were to cut rates more significantly. That's what John and Annmarie were hearing yesterday from Chris Harvey of Wells Fargo, reaffirming the 7,000 level. Do you buy that?
Well, I think that the Fed's in a tough place for all the reasons that have been discussed, right? We have still some inflationary pressures. The labor market's holding up. The earnings are holding up. The economy is holding up pretty well. The question is going to be if you start to see deterioration in that labor market. And we certainly have heard anecdotally layoffs from different companies. Some of it is specific to them. Some of it is just general industry and a lack of hiring. And I think if that starts to catch up, you could see those cuts. But because of the other issues and the prices paid index and where you're seeing inflation, I think it's very difficult to bake in as much as we're baking in right now, to be fair.
I'm trying to figure out if we've learned anything. That basically companies have been coming in with momentum. They have done pretty well. If you take a look at the earnings as a whole, Mohamed El-Erian was saying that the raw data is showing that momentum is sort of pretty robust heading into this. And then you have a Fed that has quite a lot to potentially cut if there is some sort of deterioration in the data. Is that enough for you to see this as more than just a bear market rally?
Well, I think it really is going to depend on a number of things. One of them is getting some certainty because we're still seeing a lot of pull forward because people don't know. So people are still buying ahead, not just companies pulling in inventory, but individuals making choices. That makes the data look very good in the near term. And the question is it going to soften at the end of the year, the hard data, not the survey data? So if that starts to be a problem and the Fed can cut, I think that's going to be helpful. But where markets are right now on the equity side, I think it's a little difficult to see how you can really get that next leg up unless you think that there is a path forward that doesn't have so much uncertainty and chaos. And I don't think we know that yet.
Well, the whole point of the Trump administration they've talked about is game theory, strategic uncertainty. Right. But what if we end where Trump started, 10% around the world, 60% on China? How would the market digest that?
I think there would be probably some relief in that, to be fair, because the numbers were so much higher. And I think that that's part of that game theory. I'm going to throw out a bunch of numbers and we're going to end up somewhere lower. But in the interim, you are seeing some people getting stuck trying to figure out, do I pay for things at that level? Do I cancel this? You've seen a lot of cancellations. And you've got a big freight market and an ocean freight market that's in a chaotic state right now. So sorting that out is going to take some time. And unless there's a path on the other side of that where people feel comfortable, I think it's going to be difficult.
I'm pleased you brought up the Federal Reserve. The Fed last met on March 19th. March 19th is a lifetime ago. And think about the response to that meeting. I remember the dovish interpretation, just the very idea they saw any kind of inflation bump as a one-off. Then the out years of 26, 27, inflation comes back down. Super dovish. Markets absolutely ripped. And you and I remember having a conversation about a more hawkish interpretation. This idea that they saw a deceleration in growth, and yet they didn't increase their outlook for interest rate cuts. And I wonder if the more hawkish interpretation becomes that much more relevant in the months to come. Not at this meeting, but the next one, when they have to put out fresh forecasts all over again.
Stagflation is the central bank's nightmare. Stagflation is what a lot of people are talking about, are stagflationary-like trends. At a point when that's what we're seeing on the margins, communicated in the data, like yesterday's ISM services, how do they respond to that in a way that somehow is constructive for this market, given the fact that stagflation really is one of the difficult things that a central bank has to deal with? They don't have perfect tools to counter that.
I think what the equity market would like to hear is Governor Waller, his words from Chairman Powell. How likely is that?
I think that's a bit difficult at this juncture. So I think that it would be... You'd need to see some real data changes before you could get that shift in tone from one to the other. And I'm not sure that that is anything we're going to see, certainly not this week, I don't think, and into the next month. We'll see.
How concerned are you that there appears to be not necessarily a shadow Fed, but some sort of countervailing force on the FOMC that's creating a question around political, I don't want to say interference, but political clouds hovering around the Federal Reserve?
I think that we've seen it very often that you got this argument between politics and the Fed. And I don't know that this is any worse, except that it has been, you now have a president who's actually willing to say something out loud in that way. I don't think that the Fed acts in a political way. I think that they are going to continue to do what they think they need to do for the economy, but it makes it far more difficult and it makes the bar a little bit higher if someone's pushing on you to do something that you don't necessarily want to do and you don't want to look like you're capitulating. So I think that there is an issue there.
Are you even watching the press conference tomorrow?
Always.
Okay, so what are you hoping to hear?
I'm expecting to hear not a whole lot and a dance again between that, but a dance between inflation and the labor market, right? Because that's the tension that they're going to keep calling out. The labor market still looks pretty good. Until you start to see that soften, I think it's hard to say anything that is specific about what I'm going to do. I'm going to do X if Y happens. So I think I'm looking to hear more of that dance and to see if there's any changes on the margin.
Can you just pretend it's going to be really exciting for us? Super exciting.
Absolutely. I can't wait.
Live coverage, 1:30 tomorrow afternoon on Bloomberg TV and on Bloomberg Radio.
It's going to be stunning.
There's the promo. OK, Sarah Hunt of Alpine Saxon Woods is going to stick with us with the latest news elsewhere. Your top stories in your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. The Trump administration has blocked Harvard University from new federal research grants in the latest escalation between the two sides. The move could affect over $1 billion annually. The Ivy League school would need to enter a negotiation with the administration to resume eligibility. OpenAI is backtracking on plans to become a more conventional for-profit company. The decision comes after it faced pressure from former employees and rivals, including Elon Musk. The ChatGPT maker says it will still restructure its for-profit division as a public benefit corporation, but the overall business will remain under the control of its nonprofit. And California Governor Gavin Newsom called for federal tax credits of at least $7.5 billion to attract more filmmaking to the U.S. Newsom suggested a partnership with the administration after President Trump proposed tariffs on foreign-made movies. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the programme, Canada comes to the table.
What's your expectation for your meeting with the Canadian Prime Minister tomorrow?
I don't know. He's coming to see me. I'm not sure what he wants to see me about, but I guess he wants to make a deal. Everybody does. They all want to make a deal because we have something that they all want.
That conversation up next with Bloomberg's Tyler Kendall in Washington, D.C. From New York City this morning, good morning. Here's a snapshot of the price action. Equity futures on the S&P 500 slightly softer on the S&P. We're down by 0.5%. We joked about how boring the Fed meeting might be tomorrow. It starts today, 2 days of it. BNP Paribas, nothing to do. Deutsche Bank, stay in May and see if the trade turmoil goes away. Morgan Stanley, the data says the Fed should wait, and most of you believe they'll do just that. In the bond market, 2-year, 10-year, 30-year yields look like this at the front end of the curve. Your 2-year this morning, yields lower by 2 basis points. The 2-year 381.16. Under surveillance this morning, Canada comes to the table.
What's your expectation for your meeting with the Canadian Prime Minister tomorrow?
I don't know. He's coming to see me. I'm not sure what he wants to see me about, but I guess he wants to make a deal. Everybody does. They all want to make a deal because we have something that they all want. We have something that they all want. China wants to make a deal very badly. You see what's happening to China. China is being decimated, and I don't want that to happen. But they have to make a fair deal.
So here's the latest this morning. Canadian Prime Minister Mark Carney meeting with President Trump to discuss trade. High stakes for the newly elected Canadian leader who promised to win the U.S. trade war. Bloomberg's Tyler Kendall joins us now for more. Tyler, what does winning look like, and what does the Prime Minister actually want?
Yeah, hey, John. Well, that's one of the biggest questions here, particularly as it appears that very little progress has been made when it comes to trade talks ahead of this high-stakes meeting here at the White House. Now, of course, President Trump has a long list of grievances when it comes to Canada, from fentanyl to trade imbalances. But, of course, perhaps we see it the most when it comes to those sector-specific tariffs, considering President Trump has really made reshoring manufacturing away from Canada such a focal point when talking about our northern neighbor. And we see that the most in those steel and aluminum tariffs, considering Canada was one of the top exporters of those metals to the U.S., as well as the auto tariffs. Even with exemptions, of course, it's still threatening to complicate those highly integrated supply chains across the border. Now, whether or not Mark Carney has a little bit more leeway here really does remain to be seen. We can say that President Trump perhaps has a relatively warmer relationship with him compared to former Prime Minister Justin Trudeau. Trump has called Carney a very nice man, and Carney has called him one of the best negotiators. But we have to keep in mind that Carney Carney really campaigned on countering this White House and its trade policy, saying in his acceptance speech, actually, that the U.S. and Canadian relationship is forever changed because of President Trump. Trade, no doubt, is going to be the focal point today as Canada is still faced with that 25% levy excluding USMCA compliant goods and then the lower 10% levy on energy. I will say that Commerce Secretary Howard Lutnick yesterday in an interview said that they do not have currently planned changes to USMCA compliance for now, that they will revisit that next year when the terms of the agreement expire. But when asked if he was optimistic on whether or not there could be a trade deal, he said it's a really complex situation and that today's meeting will be, quote, fascinating.
Tyler, how much has the tone changed with the president? On March 28th, after the election, he said he had a call with Carney. It was extremely productive. They agree on many things. We're going to be meeting immediately after the election, elements of politics, business, and all other factors. That'll be great for both these countries. And now he seems to be saying, I didn't really invite him. He said he wanted to come here to make a deal. How do you read these tea leaves?
Right, exactly. It's a tricky needle, it appears, that the White House is trying to thread here, that they really are trying to push, that it is up to Canada to ultimately make those concessions, particularly when it comes to President Trump's long list of grievances. He often names the specific industries that he wants to go after, including lumber, dairy, autos, things like that, that we've seen these sector-specific tariffs already hit. Now, we can note that Canada does come with some leverage to the table, of course. A new Bloomberg Business Week article out yesterday shows how a boycott of U.S. goods has already resulted in some measurable pain for Americans, particularly those in northern border states, not to mention that we've seen flights decline significantly in the last year from Canada. So we're going to have to wait and see if perhaps this could be sort of the precursor to how this relationship goes the first time that these two leaders are meeting in person. President Trump saying that ultimately it's Mark Carney who asked for this meeting, not for him. You pointed this out before, but Canada, of course, is hosting the G7 summit that's happening later this month, and we can see how President Trump's going to interact with those leaders, perhaps from what sort of tea leaves and clues we get from today.
Must watch TV a little bit later on. Tyler, thank you. Tyler Kendall down in Washington. With us still in New York, Sarah Hunt of Alpine Saxon Woods. Sarah, let's build on some of this. We've been trading on rhetoric, the prospect of deals, negotiations. When does the substance start to matter? What does a deal actually look like?
I think the problem is that because we don't have substance, we can't make those plans outright. I don't know what the substance looks like. And I think that's the biggest problem, is that there isn't a specific, absolute, I know we're looking for this ask. I know we're looking for that. And once we get that, we'll have a deal. It still continues to be amorphous. And that's why people are struggling both on the corporate side and on the investment side.
Sarah, given how integrated the U.S. and Canada are, the economies, if this meeting actually does go south, how negative could that be for the equity market?
I think it could be pretty negative just because it is one of the, this is somebody that we shouldn't necessarily be fighting with, right? This is a country that we've had a long series of negotiations and agreements with. So to put this on footing that becomes very negative, I think would be more of an outlook for how that's going to go elsewhere than it would be as much about the U.S.-Canada relationship. But I also think that that is an important relationship, and you don't want to see that go south. And I think that would be very negative.
Do you know, to Jonathan's point to Tyler earlier, do you know what a win would be for the United States when it comes to Canada and trade?
Well, I think this has been the problem throughout this last couple of weeks, where we hear about a memorandum of understanding or we hear about a trade framework, is that there isn't a clear picture for what winning really looks like. So not knowing what those parameters are, it's hard to game out what the odds are that those parameters are acceptable.
And of course, it's also a dynamic type of picture, as many of the executives have talked about. With the market playing a leading role, Julian Emanuel of Evercore ISI came out and said that because the market had performed so much better over the past 9 trading days, it gave President Trump the room to actually talk more tough talk with respect to tariffs, and that would lead to a pullback. And it sort of is this range that he's playing with to try to use the market to understand what his potential guidelines are. How much do you think about that from an investing standpoint?
I think that is exactly the problem, that the investment world tries to react so quickly and the real world cannot, that we're already over something that hasn't happened yet on equity markets. And I think that that's one of those reasons that I don't disagree with him. I think that there is an absolute case to be made for the fact that a recovery in financial markets means that you take that as, see, we can get through this. And part of that recovery was backing off to begin with and moving at 90 days. And the other part of that recovery was earnings. But how much are those earnings going to flow through continuously through the next several months because we don't know where they're going. And to Cameron's point earlier, margins are really going to be in question because the cost picture is unclear, because the supply chain is unclear. So we're already discounting something that hasn't even happened, and we've already decided it's okay.
Over the past couple of decades, there's been this focus on Wall Street about getting faster and getting a time edge on other people, getting closer to electricity sources so that you can respond to information more quickly to everybody else. Has this been the death of that getting information first is not any kind of advantage whatsoever, and that everybody has to shift to another frame of reference when it comes to investing that is longer term, more patient, more, I don't know, private, something else that is not sort of high frequency trading?
I think you're dead on right now, because I think that the absolute chaos and uncertainty that we're living through, rightly or wrongly for the end outcome, makes that information not as important because you don't know which way it should really direct things. I mean, even at Fed meetings, even before this, you could watch the reaction to what the Fed said, and that markets would be up and down in the same hour because people couldn't figure out which way we were actually going. And now I think you've just put that on steroids, and you've added other types of information to that, not just what the Fed thinks, but what's happening both in the economy and what the administration wants to do. So getting a piece of information first is not necessarily directionally easily interpreted. Let's just say that.
Friday's a great example of that. We had the port director from Los Angeles, Gene Soroka, and Gene told us what was happening with trade volumes as of this week, that we had a 30% roll-off in bookings of arrivals. And we all sit around the table and we're like, OK, what happens next? And there's a big debate about what happens next and over what timeline and what it should mean for markets, because markets might not even respond to it. They might just shake it all off on the prospect of deals on the horizon, which gives you a forward look of better economic data around the corner. How are we going to trade bad data in the next couple of months if the president is still going around saying deals, we're going to close lots of deals?
I think that there is a point at which that rhetoric no longer is as effective. And because this is also recent, again, we're talking about a 4 or 5 week period now since we even started, the rhetoric has been very effective. But the longer you go without having something done, the less you can goose things with saying it's going to be done, it's going to be done. And the more problematic it becomes when those goods are not coming over or going back, and you've got not the right things are not situated in the right way to get those trade flows started again.
This is the window. Everyone's talking about the window. No one really knows how big it is, but this is ultimately it. Ultimately, you have to show something. Otherwise, eventually you get that bad data and this market will have to trade on it.
Eventually, those ships will not have gotten here with those goods. And eventually, retailers will have to adjust. And the pricing ramifications will happen, and potentially layoffs will happen. And this is the reason why Jane Fraser of Citigroup yesterday at the Milken conference was talking about this gap between hard data and soft data and how it has to close, even though people say that it could persist. And which way it's going to close is not clear. And I really mean that, because it could close to the upside or it could close to the downside.
The president likes to anchor negotiations to the extreme, which is why he goes out there with some pretty flamboyant statements at times. The Europeans have been quite reserved through all of this over the last several weeks. This just drops. This report that the EU is targeting 100 billion euros of US goods with tariffs if talks fail. Just setting up the talks in a different way from the European side over the coming weeks.
Yeah, fantastic scoop from our colleagues over in Europe. What you see here playing out is a carrot and stick approach now from Brussels. Last week it was in the Financial Times. They were looking at 50 billion euros worth of purchases of U.S. goods like soybeans, like LNG. And now what they're saying, if we don't get a deal, we are going to go after 100 billion euros worth of U.S. goods. What I find so interesting right now about the Europeans is they don't come up a lot in conversations I have with administration officials. It's all about Japan or India or South Korea. What's going on with Canada? We're going to meet with China at some point. Europe, it seems to be silent.
At the same time, the trade chief in Europe came out this morning and talked about how if you tally up all the goods that could potentially have some reciprocal tariffs on them from under President Trump, it would equal $622 billion worth. So they're writing down on pieces of paper, calculating, like something's not adding up. So we're going to have to come out here with a threat, and maybe that's what predicated this discussion this morning.
Stocks responded to that headline. We're down by about 0.75%, just an extra inch lower on the screen on the S&P 500. Stocks a little softer. Sarah, thank you. Good to see you as always. Sarah Hunt there of Alpine Saxon Woods. Up next, Congressman French Hill with Treasury Secretary Scott Bessent preparing to testify on Capitol Hill. Just moments ago, another leg lower in the equity market, down by 0.8% on the S&P. Not too much drama, but just off the back of this headline, that the EU is targeting 100 billion euros of US goods with tariffs if talks between the EU and the United States fail. On the Nasdaq, we're down about 1%. We're down across the board. On the Russell, we're down by 0.97%. 2 hours away from the cash open. Let's get you some morning movers. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. We've heard a lot from DoorDash this morning on a spending spree overnight, announcing that they would be buying their UK peer Deliveroo. And then at the top of the hour, alongside their earnings, announcing that they would be buying 7 rooms for $1.2 billion, the hospitality tech app. That comes alongside their earnings, where they did raise the outlook. However, it is that spending spree that has shares lowers. We're off of the low. It was down 7% 1 point, now down 3.2%. Also, one of the worst performers in the S&P pre-market is indeed Palantir. They had their earnings after the closing bell yesterday. They raised their guidance. They even talked about a ravenous whirlwind, whatever that means, for AI demand. But that was not enough to satisfy investors. It might have to do with the fact that it's up 64% so far this year, the best performing stock easily in the S&P 500, so expectations were high. The final earnings we heard from yesterday after the bell, Clorox, they cut their full year sales outlook, at least the top end of it. And stop me if you've heard this one before, saying that it was macroeconomic conditions that meant that consumer slowing with spending, and they said that that slowdown would happen well into the fourth quarter. Sounds very similar to what we heard from P&G, from Colgate, for example, those consumer companies sounding the alarm, John.
Danny, thank you. Maybe not what you'd expect from Clorox, right?
Well, first of all, this is actually one that benefited during the pandemic, because people still need to clean their homes. I mean, is that...
Well, they went mental about cleaning, remember?
I know, but is
people
that...
went nuts.
Right, so maybe they just still have those stashes.
Bleach over avocados and...
Ew, that's disgusting. Please, it's horrible. Time. Okay, but so now people aren't doing that. Make dirtiness great again.
Okay. On our radar this morning, not that. President Trump saying China wants to make a trade deal, quote, very badly. Trump and Canadian Prime Minister Mark Carney set to meet at the White House a little bit later as tensions across the board continue to grow.
Absolutely, especially over the weekend. The president talking about that he's never going to stop calling Canada the 51st state. He says it's because Canada relies so much on the United States for trade. But in all seriousness, this is a very serious person. He was the central bank governor in Canada, as well as the Bank of England. He wants to make sure that Canada is going to be seen as winning when it comes to this trade alliance. So what they talk about, whether or not it's autos, lumber, is going to be really critical, especially as they start to renegotiate and have those talks for USMCA.
Pharmaceuticals as well. We've got to turn to this story. The president announcing that pharmaceutical tariffs will be announced over the next 2 weeks. Signing an executive order streamlining regulations on domestic drug manufacturing. This is another big push we're going to hear more about in the weeks to come. Each side is just looking to frame negotiations. This from the Europeans are reporting that the EU is targeting $100 billion euros of US goods with tariffs if talks fail.
Yeah, they're looking for leverage at a time when potentially they're looking at $622 billion of products from the European Union that would be tariffed or affected by some of these increased levies. A real question about what the end game is, and we have to keep coming back to this. Is it to reduce tariffs across the board? Is it to have this baseline 10% tariff? Is it to encourage different trading partners to come to the U.S. to make some sort of deal to really work together against potentially China and some of the products coming in? There's still a lot of unknowns, and it's a reason why people are still holding their breath about a rally.
Just one last story. If you're flying this morning, just turn down the volume. Just a touch. Good. Air traffic controllers at Newark Airport lost radar and radio communications for over a minute last Monday, contributing to a week of flight delays and cancellations. Sources telling us here at Bloomberg, multiple employees were placed on trauma leave.
Yeah, you can imagine why. Can you imagine for 90 seconds if all of the blinking lights go blank and you're calling into planes and saying, we've lost all visibility, so watch out for something that you might see in the sky and don't run into it. It is incredibly traumatic when you have the lives of other people in your hands, and it raises questions, especially about one of the biggest airports in the country. What kind of updates, what kind of upgrades, what kind of oversight is there? I will just say, I spoke to someone who is an emergency responder in D.C. who did respond to the crash, and I said to him, are you feeling safe flying at this time? And he said, absolutely, there are more car crashes, et cetera. At the same time, this kind of drip feed of information, not helping at all.
Well, don't turn down the volume. I would say just maybe rebook your flight, rent a car, take a train. If you read more in our story, when radar or radio frequency stop working, there are no fail-safes, one of the people said. And left unchecked, some controllers are concerned that issues at the facility could result in a tragic accident. this is going to paint an even more dire picture for the FAA as they try to go out there and also make sure they can get more employees to come and work when it comes to air traffic control.
Absolutely shocking. You can turn the volume back up a little bit now for our next guest. Let's turn back to policy. Taxes and tariffs in focus with Treasury Secretary Scott Bessent testifying before Congress today and tomorrow. Joining us now, Congressman French Hill, head of the House Financial Services Committee. Congressman, our good friend, welcome back to the programme, sir. Talk us through and just frame, if you can, your approach to these hearings over the next few days. What do you want to hear?
You bet. Well, Jonathan, great to be with you this morning. Secretary Bessent comes to both the House Appropriations Committee and House Financial Services today for the first time as Treasury Secretary. And I think you'll see questions about the president's economic policy. He's put his policy as the centerpiece of deregulation, right-sizing regulation, making sure that the American businesses and families don't have a big tax increase at the end of the year, and using a trade strategy that encourages investment in the United States, foreign direct investment in the U.S., and more fairness for American products and services abroad. I think all those things will be subjects of questions in both committees.
You, of course, French, represent the home state of Walmart. Congressman, what do they want to hear over the next 24 hours? And ultimately, what is the company saying to you?
Well, all my constituents, including Walmart, have made it very clear to President Trump and to their trade associations, who in turn have made it very clear to the White House. They want resolution and certainty as about to what the tariff strategy is, and as it relates to imported goods that would be found in Walmart or a department store. Those decisions have to be made pretty promptly, or you're going to see, in my judgment, impact on what's on store shelves this fall and even this summer. And you're going to see price increases this summer potentially as well. I think that message was delivered quite clearly by American retail businesses principally.
Well, the message was delivered, but is there understanding you got from Walmart and some of your other constituents that they received an optimistic tone from this White House about where the future of trade is actually going to end up?
Well, this is something that we've continued to talk about on this show and in Congress, which is what is the strategy? You have a China strategy, you have a trade fairness and reciprocity strategy, you have a bring business back to the U.S. strategy. Sometimes those things are in conflict and they're tough to do all at once. That's why I think that the idea of let's square things away at USMCA with Canada and Mexico, let's make sure we're on the same page with Japan, Korea, and the European Union. Those are first and foremost. I think that will help us then get the best kind of leverage we can as we work on the toughest nut in the group, which is how do we have trade fairness and end China's mercantilistic trade policy around the world.
Congressman, though, did Walmart, though, leave that meeting in the Oval Office feeling like the president heard them and that they're listening to their concerns?
Well, from the reports I've got, the answer was yes. I mean, President Trump worked very hard in his first term to make sure that consumers were not immediately impacted by his tariff negotiations as he attempted to design a tariff strategy that would bring jobs back to the U.S. and foreign direct investment back to the U.S., but not hit consumer pocketbooks directly. And so I think that was the message that was delivered, and from what I've heard, I think he got that and heard that message quite clearly.
Do you have a sense, and maybe you're going to get this from the Treasury Secretary this week, of a timeline on when all these negotiations would actually come to fruition?
Well, as I've said, based on talking to my constituents, whether they're big European, Mexican, or Canadian relationships that we have in Arkansas, or a big global company like Walmart, the sooner that we have clarity and certainty here, the better for business planning. I think that's good for business outlook, and I think that's good for the American economy, is to have certainty. Nobody questions the desire to have better trade fairness, improve USMCA, stop dump goods from coming into Canada and Mexico and into the North American market. Those are all worthy goals, but the question is we need realistic strategies to achieve them, and we've got to make sure that we can clearly communicate that to the American people.
Congressman, there also is this question of how feasible it is to get some sort of tax deal, one of the other prongs of Secretary Bessent's goal through Congress at a time where there are a number of red lines that need to be crossed. That's expanding the deficit, potentially cutting Medicaid Medicare or Medicaid in order to get no tax on tips and some of the other sweeteners. How feasible do you think that it is to get some sort of consensus among your colleagues on that?
Well, we've had 7 of our committees now report their reconciliation plans. Next week, you'll see Agriculture, Energy and Commerce, Ways and Means conduct their work. These are important committees. They have the bulk of the savings in those committees to be debated among members, and then what is that tax plan? And President Trump has absolutely been leading in private meetings with Secretary Johnson, with Speaker Thune, with Ways and Means Chair Smith, and Chairman Guthrie at Energy and Commerce. And so I think we're going to find that right spot where we can hold Republicans together and meet the president's objectives for reconciliation. But the next 2 weeks are very, very important.
Yeah, that's what I was going to ask, Congressman. How quickly does something need to get passed for there to be a positive spin at a time where there's a 3-legged stool and one of the legs is really remaining in question, or actually 2 of them are, the trade policy as well as what gets actually passed? How quickly does it have to get passed for there to be a change in tone, certainly among polls?
Well, I think it's important. We've put a premium on the House under Mike Johnson's leadership of getting the tax and spending reform plan through the House as soon as possible. And you've seen, as I said, 7 of our committees have already done our reconciliation work. In the next 2 weeks, we hope to complete it. I think that sends the message to the Senate that the House is serious. The House has the votes. We want to get President Trump's spending and tax priorities through the Congress, and that, I believe, will send the right signal both to the economy, to planning, and be a key plank, as you noted, in the president's economic policy.
Congressman, but you know, of course, we're going to need pay-fers, and our audience is keen to know where you stand on this issue. Do you think stock buyback tax could be on the table when it comes to this reconciliation package?
I think the stock buyback tax is a dumb idea. It was a dumb idea when Chuck Schumer offered it. You're hurting individual shareholders. You're hurting pension plans. So I don't think that's something that should be used. I think it hurts economic growth, and I think it hurts individual family investments in their pension funds and in their individual accounts.
At your blunt best. Congressman, thank you, sir. As always, appreciate it. Congressman French Hill, great to hear from you, sir. Thank you very much. A lot to be done down in Washington, D.C.
They have a ton to be done. And I think there, just speaking to French Hill, you got a sense, the head of the financial services, that there's so many questions on a timeline when it comes to trade. And then there's questions on what gets in this reconciliation package and how are they going to offset it. Clearly, he doesn't like the idea of, stock buyback tax, but there's going to be other things they're going to have to do if they want to get all these sweeteners into this bill.
Does it go beyond just extending TCJA? And what you hear from the president is certainly it goes beyond that. I wonder if Congress is completely on board.
If it doesn't go beyond that, is it stimulative? Or is it basically an extension of the status quo with the offset of some of the growth negative implications of tariffs? A lot of questions. The 3-legged stool is looking a little conceptual, and we're just trying to see it, and we want some, visuals. Just, get a couple images maybe today.
That was helpful. All right.
Thanks.
Equity futures down about 0.75% on the S&P. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Arnold. Hey, Yahara.
Hi, John. Philips cut its profit outlook for the year, citing the cost of rising trade hurdles. The Dutch medical technology firm estimating a net tariff impact of up to $340 million. Philips CEO Roy Jacobs told Bloomberg the company plans to localize more production in the U.S. in response to the levies. Meanwhile, Nike is reorganizing its senior leadership team under its new CEO, Elliott Hill, who wants to return Nike to its sports roots. He said in a statement the company is resetting its priorities and changing its top structure, with the president of consumer, product, and brand retiring, while other executives will take on new roles. And the Met Gala has outdone itself. The New York Times reporting the annual fashion event raised a record $31 million for the Costume Institute. LeBron James was the honorary chair for the 2025 gathering, and Kamala Harris made a surprise appearance. That's your Bloomberg brief. John?
Hey, Yahara, thank you. More from Yahara in the next hour. Up next on the program, facing down an economic cliff.
There's no reason for the Fed to be cutting or signaling that they're going to be cutting anytime soon. At this point, the economy is fine. The challenge is looking forward. There's a pretty big cliff from an economic perspective heading into the next couple of months.
We'll talk about that cliff next on the program. Jonathan Pingle of UBS from New York City. You're watching Bloomberg TV. Just got a note from Andrew Honhorst over at Citi. Just one word, front-loading. Max Kettner of HSBC helps to elaborate. He says this: where we've seen upside surprises in hard data lately, this has largely been due to front-loading. Forward-looking indicators are for hard data to fill the pain soon, perhaps already in the next month or two. That seems to be the take. Heard the same thing from Anna Wong of Bloomberg Economics. The May data is the data that starts to sour. Going into all of that, equity futures negative by 0.75% on the S&P. We're down by 1% on the Nasdaq 100. Under surveillance this morning, facing down an economic cliff.
There's no reason for the Fed to be cutting or signaling that they're going to be cutting anytime soon. At this point, the economy is fine. They don't want to get ahead of this. They're going to have to just wait and see what the impact is. The challenge is looking forward. There's a pretty big cliff from an economic perspective heading into the next couple of months.
So here's the latest this morning. Traders expecting the Fed to hold rates steady tomorrow despite concerns about an economic slowdown. Jonathan Pingle of UBS writing, we see a worsening growth and inflation trade-off facing the FOMC. We expect no changes to the policy stance. Jonathan joins us now for more. Jonathan, welcome to the programme, sir. You're certainly not alone, expecting no change tomorrow. Most people expect no changes. What happens after that? This came from Jan Hatzius of Goldman. He said, we expect enough evidence to accumulate for a cut by July. Jonathan, do you think we'll have enough evidence by July to make that kind of call?
No, I mean, so first of all, I actually have a lot of sympathy for Jan's forecast at the moment, where ours isn't that much different from his based on what I've seen. But I'm expecting that the May data looks okay, and it's really going to be sort of June, July, August data that's released July, August, September that makes the case for rate cuts at the September meeting. But, it's one of those things where, your previous speakers were talking about it. We think you're going to start to see some of the inflation impacts in next week's CPI report. I just think the labor market's going to lag a little bit. And I think that's really what's going to drive the Fed's calculus over rate policy eventually, if it's weak enough anyway.
That goes to the heart of the question, Jonathan. Has the damage already been done? Is there already enough moving down the pipeline to cause some sort of near-term inflationary surge at the same time as a downward kind of pressure on the overall economic growth trajectory?
I mean, I think that's right, Lisa. I don't think it's like a discrete jump at the moment. But, if all tariffs went away, I would not snap back my GDP forecast to where we were, and we would not snap back our inflation forecast to where we were. But I think you're at a crucial sort of 4 or 5 months juncture here where every month that lasts longer, the more the economic damage is going to be done. And, as I've sort of been trying to tell people, if the bulk of these tariffs stay in place for the bulk of the year, I mean, the bulk of the economic damage is going to be done.
There's a larger question here about if there is some sort of trade resolution and there is some sort of better tone in markets, could there be an inflationary shock in addition to pretty solid growth? I mean, we've been talking about stagflationary types of wins, but a lot of the companies in their earnings reports portrayed a pretty positive backdrop in terms of economic growth. Is there an upside risk for a Federal Reserve that has to be cautious about how quickly they cut rates?
Well, I think that's exactly the kind of trade-off they're facing, is that they don't know. I mean, equities have rallied back pretty impressively, actually, following the drawdown after the April 2nd announcements. So that's exactly the challenge for the Fed. And Chair Powell, we expect on Wednesday, is going to say how the dual legs of the mandate might be in tension. If growth holds up fine, this is a Fed that could be on hold for a long time, or if the inflation trade-off is bad enough and growth is fine, maybe even put hikes back on the table. I think, though, one of the questions I think they're going to face, though, is if the labor market weakens sufficiently, I think they're going to end up asking themselves, what are the points of the tools? Because at some point, there might not be anything to restrain, right? If the labor market's weak enough, what are you trying to restrain, right? I mean, if it's slackening the economy for you due to the negative growth impacts, it sort of calls into the question the role of restrictive monetary policy in the first place. So, it is a really tough spot for the Fed, and and the potential outcomes depend a lot on really uncertain data forecasts.
Just want to carry that through. Are you saying that at a certain point, if there's an inflationary impulse at the same time as weakening growth, there's not really much that this Fed can do, that it's kind of out of tools?
Yeah, in a way. I mean, they'll have other questions to ask, like, is their credibility being called into question, or longer run inflation expectations becoming unanchored higher? But, when we were roaring out of the pandemic, there was a role for higher rates to play in restraining the supply-demand mismatch. I mean, aggregate demand and the labor market were just surging. I mean, there was a role for rates to play in restraining that growth. If growth is contracting, or the labor market's contracting, or the unemployment rate's rising rapidly, monetary policy doesn't really need to be there to make it rise faster. If non-farm payroll employment tips negative, they don't need to make it more negative. So there might be a point at which the usefulness of the tools become an important question.
Jonathan, can we do psychology? Does legacy have a role to play? Does the legacy of Chairman Powell have a role to play over the next 12 months when he knows after this he's out, he's done?
I think the legacy struck me in March, because it became clear in March when you looked at the SEP that this was a chair who no longer expected to get inflation back to 2% on a sustainable basis during his current term. Now, I think history could be written a number of different ways, because if I look at the incoming data on the ECI, the recent inflation data, average hourly earnings, I think it looks like they are on track to nail the soft landing. So whether this next surge is a fault of, if history writes this as a fault of the chair or the tariffs or the next Fed chair, I mean, that remains to be seen. And I think we'll have to see how it plays out. But I have been struck. I do think the FOMC was getting close to nailing the soft landing. But at this point, I think it's probably going to escape Chair Powell's term.
The situation certainly gets harder, that's for sure. Jonathan Pingle, UBS. Jonathan, thank you. Annmarie, that conversation's already started. The interviews, according to the Treasury Secretary, Scott Bessent, speaking to you, begin in the fall.
Begin in the fall, and then pretty much there'll be leaks, and we're going to know who potentially Trump is going to give the nod, and then you're going to have this idea of a shadow Fed chair. Trump was asked about this over the weekend. He said, I'm not getting rid of him. You press ran away with it, although he did use the term termination. But he doesn't like what the Fed is doing and thinks actually it's personal. And I'm sure after we get the Fed decision, which is going to remain on hold, you're going to hear the president once again, jawbone Jay Powell.
If central bank independence wasn't important to this market, if this was just any other role, he'd be fired already. I think that's an appreciation from the Treasury Secretary and an agreement from the President of the United States just how important that particular position is to financial markets, which again reinforces this view that there is a put, that they are conscious of things and they are nervous about upsetting markets too much.
Yeah, and if they were to fire Fed Chair Jay Powell, it removes a scapegoat, right? I mean, if things go awry, it sort of goes to Jonathan Pingle's point. Who gets blamed, right? Well, the finger is up in the air trying to figure out how to point to somebody else, and that seems to be Fed Chair Jay Powell, who is certainly in the pointed at seat.
We've said it a million times. You're going to get that news conference tomorrow, and then you'll just get the live blog from the White House about the White House's thoughts on where policy should be. And obviously, they think policy should be lower. Rates should be cut. Up next on the programme, Peter Tchir of Academy Securities, Jason Bazinet of Citi, Luke Tilley of Wilmington Trust, and Oksana Aronov of JPMorgan. The third hour of Bloomberg Surveillance is up next.
It's not about where we've been. The markets are thinking about where we're headed.
The markets have kind of repriced very quickly any kind of risk premium.
There's clearly hesitation and a pause until we get clarity.
It's not smooth sailing from here.
There is some upside potential. That's why I think you've got the stock market sniffing this out.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
So we snapped a 9-day winning streak on the S&P 500 in yesterday's session, and we add to the losses this morning. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P, negative. We're down by 0.8%. We're down on the Nasdaq too by 1 full percentage point, going into an important testimony over the next 24 hours from the Treasury Secretary Scott Bessent on Capitol Hill at a time where the president is talking up trade deals and Europe is considering retaliation.
Yeah, talking about potentially 100 billion euros of of goods in retaliation would be tariffed for the United States. A real question here about whether we actually have tamped down some of the rhetoric and the heat around trade negotiations, or whether they're just getting started. I really do think that the discussion with the Canadian Prime Minister and President Trump today is going to be key in determining just how much we have brought the temperature down.
And how quickly those deals can actually get done. Because if you can't do a deal quickly with your northern border, what does that mean? Your northern neighbor, what does that mean for every other country? When it comes to Europe, I'm so fascinated by this carrot approach last week. We're going to buy 50 billion euros worth of goods, soybeans, LNG. And then today it's our reporting from our colleagues in Brussels talking about the fact that actually they're eyeing maybe retaliation. But these Europeans, the deal making has been scanned. You see the administration line up the likes of India, South Korea, Vietnam, Japan. When it comes to Euro, they're really low on the list.
We've spoken to a lot of guests already this morning about this window. The window apparently is closing. We're facing this economic cliff, this air pocket for the hard data. Thank goodness we haven't hit it yet. The hard data's been okay. Payrolls on Friday, you mentioned ISM services, pretty decent as well. I know that companies are having troubles forecasting, but the underlying earnings are still okay.
Which is a reason why there still is momentum that gives people a sense that the U.S. can avoid the R word. I've heard that people don't like using the R word. Have you noticed that? That people really shy away from saying recession and they seem very skittish
it's
about it?
resilience now.
Oh, is that the R word?
No, I think we're thinking of the same thing. Mark Rowan, Apollo.
Yeah.
In a conversation with Shanali yesterday, he said, I think we will get 2 quarters of negative growth.
Right.
He didn't say recession.
Exactly.
Recession feels very loaded.
It seems like people are trying to remove the heat from some of the language that they're talking about. I do think when you look at the hard data, what is going to come in first is the inflationary data. And that's what we just heard about, that it could, from Jonathan Pingle, it could show up as soon as next week's CPI data. If you start to see that type of inflationary pressure, how much does that pressure the Federal Reserve as they try to remain out of the spotlight?
Mark Rowan also said this: I see us moving from was hyper-exceptionalism to merely exceptional. But can you make sure that you keep merely exceptional unless you have the 3 prongs of the stool? And that, I think, is what the Treasury Secretary spoke about at Milken. And he's really going to try to nail that the next 2 days when he's up on Capitol Hill.
Mark was fantastic yesterday. More conversations coming from the team on the ground on the West Coast. The Milken Conference in focus on day 2. Equity futures on the S&P negative here by 0.75%. Coming up on this program, we'll catch up with Peter Tchir of Academy Securities on a headline-driven market. Jason Bazinet of Citi as Trump's tariffs threaten Hollywood, and Oksana Aronov of JPMorgan on the need to diversify beyond treasuries. We begin this hour with stocks lower after snapping the longest winning run in 20 years. Peter Tchir of Academy Securities writing, policies and deals will take their turns driving markets. I am neutral with a slight negative bias on both risk and bonds. Pete joins us now for more. Pete, good morning.
Morning.
Risk and bonds, same bucket, neutral. Why?
I think the problem with bonds is going to be that first we get some inflation pressures from everything that's going on with trade, and then maybe we start seeing, and I'll use the word recessionary kind of vibes, so that we then can, rally in bonds. But I think first we're going to get a little bit of fear from, the inflation scare that's coming with the tariffs. I think Powell's going to be very hawkish tomorrow. And then secondly, I think on risk, I was already worried so much has been priced in. And I thought Pessant yesterday did a very good job with the 3-legged stool approach. Yep. And we started with that like 2 months ago. I don't think we'd be where we are. Instead, we went down these various paths. And I think we have really hurt the American brand. And I think some of this is starting to creep into the data. When you look at company sales, it looks like Europe and the rest of the world is not buying American brands quite as much. That's starting to creep in. And I think the jobs data last week was kind of a mess up and was very artificially inflated by the birth-death model. So, they try and attempt, and it's based on the applications of EIN. So I think they're doing their best, but there is nothing that's telling me a bunch of people said in April, let's go start our own business. This felt like maybe people getting laid off, trying to join the gig economy. You look at things like law school applications are way up. All those things tell me there aren't a lot of jobs. I think the EIN applications were more a sign of desperation than real faith in the economy. So I think and that was 400,000 of a total of 200,000 jobs. So it was a huge, huge chunk of the report.
3 things that don't help equity markets: recessionary vibes, you've got doubts about resilient data, and then you threw in there a hawkish Chairman Powell. Given the previous 2, what makes a hawkish Chairman Powell?
I think he, unfortunately, they seem wedded to the official data. So I think they have an inability to either look through or say, this doesn't make sense, and they are kind of stuck with the official data, which in this case, I think he was already leaning towards wanting to be hawkish. He does not want to get caught cutting, and then all of a sudden a bunch of trade deals come up, and he has to go and like hike or anything like that. So his bias was to be hawkish, and Friday's unemployment or NFP data gave him everything he needs to be hawkish. I think he's going to stick to that mantra.
There is a sense, too, of how they become data dependent at a time where the data is very backward looking in a quickly moving economy. Do you have any expectation that there will be a different tone around that, around when they might get a sense of just how quickly the data is changing in response to trade policy?
Where I could see him pivoting is talking a little bit more about the tariff policy and say, as we understand the tariff policy, maybe we can, preempt the data. That's the only, but again, even there, right, we still have no idea what this tariff policy is going to look like. It's over a month now. We still have had no deals. It doesn't feel like deals are coming, that strong. I'd go and, the only sign we've had of any deal was the Ukraine mineral deal. And that was way weaker than I think Trump was leading us on to believe 2 months ago, right? The deal was originally supposed to pay for all the weaponry and military equipment the U.S. has already sent. It's not doing that, right? It's only paying for things going forward. It's very unclear how quickly, U.S. companies will get into Ukraine, how profitable this stuff is. So I think if that was a weak deal, I think that might explain to why we're not seeing the tariff deals.
But in mid-April, the Fed Chair Jay Powell talked about how the tariff rates were significantly higher than they were expecting. But there's been a reprieve. Doesn't he need to show some flexibility on the direction of travel if this administration has told you that they're going down? And they also agree that these rates are unsustainable.
He's spoken about, since then. I think he can acknowledge some of that, but they're still going to be high. We're higher than the rest of the world's charging us. And there hasn't been this actual deal, right? I think India offered 0 and 0 on a bunch of products, and we're saying no to that. So, I think it's very difficult when Trump goes on, air and says he's going to set the deals, he's going to set the rates. So how do you respond to that? And, out of nowhere, all of a sudden, we're going to tariff Hollywood and, reopen Alcatraz. So I think he's right to be cautious and say, until deals are finalized, we can't really play where this is going.
Well, I don't think he's going to be asked about Alcatraz, but there is one development this week that maybe he will, and that's the fact that crude in America is under $60 a barrel. Isn't that very helpful for a Fed that maybe is looking for inflation to come down and potentially a willingness to say we could maybe cut rates?
I think it does show signs to me that people are getting concerned about oversupply and recession. Having said that, the Fed has been very clear in my entire lifetime that they view energy prices as transitory, right? And energy tends to go up and down, and they try not to base too much policy strictly on oil alone. I think that's actually been one of the mistakes maybe when Trump has been pushing on Powell. Don't just focus on energy, focus on other things, because I think the Fed is very willing to look through energy prices going down as transitory.
At this point, you're neutral on bonds, you're neutral on risk assets. Some people say that the same thing at this point. What are you bullish on at a time when you've got European stocks potentially geared for their 11th straight day of gains, which would be the longest or matching the longest streak, I believe, going back to 1999?
Yeah, so I would still be biased to be slightly long, foreign stocks. I've actually been recommending increasing exposure again to Chinese stocks. I think where this is all playing out right now, it looks like we're being a little bit weak on this. They cut some of the tariffs on things that they actually need to keep their production. They seem to be making more progress in terms of getting around the globe and striking deals. One issue that we keep looking at when we're at Academy Securities is we just feel very understaffed globally at the U.S. entity, right? There's too few deal makers, right? It's other countries, I think, have legions of people and teams out there, and it follows a much more traditional business model, right? You have the junior people talking that, they make light deals, and it keeps going up. We have a few senior people, I think, trying to do everything. I think that's slowing us down and leads to mistakes.
I want to finish on something that you've talked about a million times, and that's the brand, the American brand, and how it's perceived internationally, and not just financial markets, but also U.S. goods being sold abroad, services as well. How much damage do you think we have done?
I think there's a fair bit done. I think, again, we go back to this. I view that, foreigners wanted to buy U.S. goods because it was aspirational. They wanted to be affiliated with U.S. brands. And I think you're seeing less of that. You're starting to see some tech companies, their earnings overseas have been a little bit weak. And and I think this goes beyond the tariff and trade related. So I think that it's hard to separate right now. There is noise around tariff and trade. But I think beyond that, I think consumers globally are saying, what's an alternative to a U.S. brand? We are so annoyed with the messaging coming out of the U.S. that we want to see if we can support our local brands, do something else. And I think think that's going to feed in. And again, 40% of S&P 500 profits come from overseas sales. So that's something I don't think we're pricing in at all. We've been so fixated on tariffs and deals and this and that. I think if we've done some permanent damage to U.S. brands abroad, that's going to be a much, much bigger problem.
That's a strong word. Why do you think it's permanent?
Let's say it's a year to 2 years. I think it's already, it's riled people so up. If you just look internally, right, how riled up are, I spend probably too much time on, social media, but you look, 1/3 of the comments are like, this is glorious, look, 1/3, this is awful.
The Canadians are furious. We've heard from many of them. They are absolutely furious. And I think today's meeting down in Washington goes some way to speak into exactly that moment. What can they do to repair this, if they even want to repair it?
Yeah, and you're seeing, stories about both in Canada and Europe where people are turning U.S. brands upside down on store shelves so people can just bypass them or not look at them. So this is something real. I think on the tech side, people are starting to say, well, how associated do we want to be with this? And even on the military development side, right? If Germany and them were really going to spend money, you would have thought they'd be using U.S. defense contractors. But the excuse is, well, we're worried about what Trump says or does down the road, whether we will get access to the pieces and parts that we need. And it's just been such a vicious kind of push on countries that I think that lack of trust. And again, Japan, I think, negotiated a deal with Trump in 2019. USMCA was under Trump in 2018. Even if you get a deal, do you believe that if Trump doesn't like the prospects in a year or so? And then more and more people, I think, when we look at trade, to me, it's almost become flabbergasting at this point. We look only at goods trade, right? We should add services in. The U.S. is dominating in services globally. Sure. That would reduce the trade balances. And then if we tried to put in any sort of measure of profitability of trade, I think we're probably crushing it with most of the rest of the world, right? We tend to import low-margin goods. We tend to export high-margin goods. So the fact that we kind of seem so narrowly focused on trade balance on goods seems strange. We're ignoring per capita. I think this is all pushing back on us very hard.
When we saw those headlines at the start of April, there was a worry, and I think we shared that worry, that they were going for it. They were looking to rewire the global system. And Lisa, we talked about it. Was this a shock to the cycle or a shock to the system? I have noticed a hesitancy regarding rewiring the global system based on the headlines we've seen over the past month.
A hesitancy of the market blowback and how quickly they are executing it. It sort of is exemplified by the delay for the auto manufacturers to get more accustomed to the new regime. It's unclear what this new system is, and that, I think, is the difficulty. We don't have a sense of just what the ultimate goal is, and that's leading investors to be worried.
And I think one mistake this administration, to me, has been making is they make a move. If they don't get the move they didn't expect, they try and make some other move, and they're not thinking, what does the other world do? And we might be trying to restabilize. I'm not sure we didn't set in motion a destabilization, because other countries are saying, oh, yeah, that's really nice, U.S., that you want to pull back, but you started this. We're no longer comfortable. So I don't know that it's as easy to pull this back. Yes, the U.S. is trying to walk it back a little bit. I'm not sure, A, the rest of the world views that the U.S. is trustworthy in walking it back. I'm not even sure the U.S. markets think we're trustworthy, that we're permanently walking it back. But secondly, I think the rest of the world has started things in motion that are going to change, and that's been the response function. And this administration has to realize people are not behaving the way we expected. People have understood, art of the deal and are playing Trump very differently. And I think we have done a poor job analyzing what other countries are likely to do and responding to that, and we've got to get back from that. I do think Besant's better at that.
Well, at least America has a government right now, because Germany's falling short. Let's cross over to Germany and catch up with Bloomberg's Ollie Crook. Ollie, welcome back to the programme. For those of us just tuning in, wondering what's been happening over in Berlin, what's the latest?
Yeah, you'd have a good question, a good reason to be questioning that, because we are not entirely sure. We now have got the information that we heard initially that the first vote had failed for Friedrich Merz. This was supposed to be a day, remember, of tranquil handoff from this former coalition government to this new coalition government. That was supposed to be all done, buttoned up by 3 p.m. And from what we understand now, in about 1 hour's time, they're going to vote again, because the initial vote, the initial rubber stamp that there was supposed to be in order to bring in this new CDU chancellor, Friedrich Merz, into the office today, failed. They're going to take another stab at it, from what we understand, in about an hour's time. We should say that going into that vote, we do not know where the vote failed. We don't know if it was from the SPD side. We don't know if it was from the CDU side. It is not clear exactly what is going to happen here. If this vote fails again, there is still the opportunity to hold other votes in the days to come, but there are going to be some serious questions raised about whether or not Friedrich Merz is going to be the right man to be the Chancellor of Germany, and what possible configuration could going forward, which will throw into question so many things that we can't really even begin to disentangle. We really need to see what happens within the next hour, but we have to say what was supposed to be a procedural day to take us from a very chaotic political system in Germany with a three-party coalition to something much more stable, that grand coalition that we've had had many times over the last few decades. That transition was supposed to happen today. It simply did not, and we really do not know where things are going to land. We'll find out a little bit more clearly within an hour's time.
Ollie, for US-based investors that heard a lot about German stimulus, does it put a question mark over that at all, or is that already signed, sealed, and passed?
So listen, it's already signed and sealed. So the difficult part was amending the German constitution with 2/3 of the parliament in order to do that, to release the debt brake, in order to get that €1 trillion worth of spending. But I think it does throw into question really the sort of effectiveness of any kind of German government to get anything done, to get any agreement. If you cannot even get your chancellor candidate, this coalition agreement was signed formally yesterday. The next day, you can't even get the chancellor into office. There's going to be a lot of questions about how quickly you can deliver that and how much consensus there's going to be on where that money should be spent. I think that is going to put some of that into jeopardy. We should say at the headline level that €1 trillion has been secured. But again, in a sort of world of non-zero chances in politics across the world and within Germany, I think anything is on the table. So we'll have to watch very closely what happens within the next hour.
Ollie, thank you. An update from Ollie Crook out of Berlin. If you've got doubts about the US dollar because of US policy, just remember, politics in Europe is incredibly messy. Careful what you wish for if you want to go somewhere else. Euro dollar right now, 113.28. With an update on stories elsewhere this morning with your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. Staying on Europe, the EU is planning to impose additional tariffs on about $113 billion of U.S. goods if trade talks with the U.S. fail to produce results. Sources telling Bloomberg the proposed measures will be shared with member states and consultations will last for a month before a list is finalized. Meanwhile, Ford shares are falling more than 2% in the pre-market after it suspended full-year guidance and warned Trump's auto tariffs will hit profit. The automaker said the duties would cost it $1.5 billion in adjusted earnings before interest and taxes. Still, Ford's tariff exposure is less than its rivals since it produces 80% of the cars it sells in the U.S. domestically. And it was a winning night for New York sports. The Knicks took Game 1 of their second-round series on the road against the Boston Celtics in overtime. They came back from a 20-point deficit in the second half. And the Islanders won the draft lottery to land their first overall pick in next year's draft for the first time since 2009. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the latest. More from Yahara later on this hour. Up next, the morning calls, plus Jason Bazinet of Citi as Trump's tariffs threaten Hollywood. From New York, this is Bloomberg. At the moment, struggling to avoid a second morning of losses on the S&P 500 following 9 consecutive days of gains. We're down by 0.8%. On the Nasdaq 100, we're down by a little more than 1 full percentage point. That's the price action as things stand. Here are your morning calls. First up, Barclays raising its price target on Ford to $9, saying its future depends on its execution. The stock is down by 2% after suspending guidance. Your second call, Citi, cutting its price target on PayPal to $95, reflecting a more moderate and prudent macro environment. That name is down by 0.9%. And your third and final call from Morgan Stanley, raising its price target on Mattel to $17, expecting a less severe impact from tariffs. That name down by about 0.6%. Media stocks falling after President Trump threatened 100% tariff on movies produced overseas. Jason Bazinet of Citi writing, investors have viewed Netflix as immune to tariff risks. That may no longer be true. Jason joins us now for more. Jason, welcome to the programme, sir. Good to get your thoughts. Another shocker. Another shock to ultimately deal with and process without much detail or clarity about what happens next. Just how exposed do you think Netflix actually is?
Well, I think if the 100% tariff went through, I think they would be very exposed. I suspect that what Trump is really trying to do is just nudge more production into the U.S. And there we estimate that U.S. production costs are maybe 35% higher than overseas, and so that will limit the damage, I think, to Netflix.
So, Jason, you think that this is a maximalist approach and that Trump is not actually going to implement 100% tariff?
Well, I look, there's a lot of questions on the street about whether he even has the legal authority to impose a 100% tariff. There's a law in the books called the Berman Act, which says you can't impose tariffs on intellectual property. In Trump's tweet, he cited national security concerns related to the production of movies. So he's going to try and get around it. That sort of raises all sorts of legal questions. So I think, like Trump always does, he's just trying to get maximum leverage early on in the negotiation. But I think the ultimate goal is to nudge more production on U.S. soil.
And he has Governor Newsom coming out and talking about it. He has industry leaders coming out and talking about it. He said yesterday he's going to have a meeting with all of them. What would a federal tax credit for the industry mean?
Well, it would. I mean, it depends how large the tax credit is, but ultimately, the tax credit would have to be large enough to more than offset the production savings that the media companies enjoy by producing overseas. So if you had, let's assume my 35% number is right, if you had a tax incentive that was larger than the 35%, you could see production move to the United States, and it would actually be an earnings positive for these media companies. If it's smaller than that, it would be a negative to earnings, but would boost employment and sort of help the overall U.S. economy.
Jason, not to get philosophical, but what does it mean to be produced in the United States? Is that a clear concept to you?
No, it's not a clear concept. I mean, a lot of these movies and TV shows, have a hybrid approach. And so every production is different. It's not black and white like something that's manufactured. And so it's a gray area. Very, very tough in my seat to analyze with precision. But I think the broad goal is just get a larger percentage, let's call it that, produced in the United States.
Jason, a tax break sufficient to achieve that? What makes it so much more expensive to produce content in this country?
Well, mostly it's labor costs. I mean, that's the main thing. And then a lot of the overseas markets are providing tax incentives as well. So you've got a twin benefit if you produce overseas, tax credits and lower labor costs.
And that should help them with the pricing of the overall product as well, Jason. I think we wanted to finish on that with you. Just how immune and insulated is a company like Netflix going up against the prospect of an economic downturn? I know we haven't seen it in the hard data just yet, but how worried should we be?
Yeah, I don't think particularly worried. Netflix's advertising revenues are, call it 1 or 2% of the overall revenues. I think they'll be able to grow ad revenues even if we see an ad recession, just because they're in such a nascent, part of their arc in terms of moving into the ad market. In terms of subscriptions, when we run the math, Netflix is still the cheapest app service out there for video on a dollar per minute consumed. So it's probably half the cost of a company like Disney. On a per minute consumed, it's probably 1/5 the cost of streaming services like Paramount or Max or Peacock on a per minute consumed. So I think reasonably insulated from recession risk.
Interesting. Appreciate the framing. Jason, thanks for your time this morning, sir. Jason Bazinet there of Citi. Jason mentioned Disney. You'll hear from Disney, the Walt Disney Company, later on this week. Up next on the programme, we'll get you some trade data. That is just around the corner. We'll get the view of Luke Tilley of Wilmington Trust and a reaction in the market from Oksana Aronov of JPMorgan. From New York, this is Bloomberg. The opening bell about 60 minutes away. Equity futures at the moment positive, or rather negative by 0.8% on the S&P. We're down by a little more than 1 full percentage point on the Nasdaq 100. On the Russell, down 1 full percentage point. In the bond market, yields just a touch lower here, Lisa. On a 2-year, we're down by 3 basis points, in and around 380.
Yeah, heading into a Fed meeting that is going to be fraught, even though the goal is really to say nothing. There is a tension right now with inflationary data coming from ISM services, with that prices paid component coming in at the highest level going back to January of last year, of 2023. It raises a question. How do they deal with slowing growth and higher inflation?
When you focus on the data recently, there's some words that come up repeatedly, including this one, front loading. A renewed focus on the trade balance in the United States of America and a lot of imports. With that data, here's Mike McKee. Good morning, Mike.
Good morning, John. We've got a record trade deficit. You saw the record goods deficit earlier in the week. Now we've got $140 billion when you add in services, which are generally a surplus for the U.S., but that's still a record deficit. It does not show progress made in the president's efforts. Right now, we see March exports up by $500 million more than February. Imports up by $17.8 billion. So what we're doing is reflecting a lot of the pulling forward of orders because of tariffs. Year-to-date, goods and services deficit is up 92.6%. 92.6% from the same period in 2024, the first quarter of last year. So it is a major change for the worse. And of course, this does weigh on first quarter growth. We'll see certainly some revisions and maybe revisions lower in terms of growth once we get the update at the end of the month.
Mike, what does this mean for the FOMC? Two-day meeting begins later on this morning. You can tell us precisely when. Concludes tomorrow. The incoming data, some of it has been flattered by this so-called front-loading. How much will they read into some of the resilience we've seen over the past few weeks?
Well, I think they've put a lot of credence in the idea that there's front-loading, and that's what's driven some of the strength in at least business spending. Remember, in the first quarter, business spending up 9.8%, and a lot of that is efforts to get ahead of the tariffs. The question for the Fed is going to be, what is the consumer going to do, especially if, because we've pulled all this stuff forward and now we start to see empty shelves, there may be less for people to buy. That's what they've got to try to figure out. But since we don't know what the tariffs are going to be, who's going to pay the tax and when, that's a question they can't answer. So I would expect them to do as little as possible tomorrow.
Mike McKee, thank you, sir. We've heard that word so many times, haven't we? Front-loading. Max Kettner, HSBC, earlier on this morning, we've seen upside surprises in hard data. This has largely been due to so-called front-loading. And for a lot of you, economists are looking for this weakness to emerge over the next several months. Now, maybe it doesn't. Anna Wong of Bloomberg said the fallout should be very visible in the May payrolls report. We heard from Stephanie Roth on Friday from Wolfe Research, who said the economy is solid right now, but heading into the next couple of months, it's going to take a big turn. And this, Lisa, came from Jan Hatzius. Expect enough evidence to accumulate for a cut by July.
Yeah, and then consecutive cuts in September and then October, each 25 basis points at a time when people are expecting the hard data to catch down to the soft data. This is what Neil Dutta has been talking about, the idea that because of the pull forward, the kind of front-loading activity that's taking place, it has buffered some of the data that we've seen, the hard data, and it's the reason why soft data actually is more relevant than it has been in the past.
Mike, just confirming the two-day FOMC meeting began this morning at 8:30 Eastern Time as scheduled. Luke Tilley joins us now of Wilmington Trust to get into some of these issues. Luke, welcome to the programme, sir. Now, you have maintained a forecast of 1.8% GDP. Unlike the others who have been running around without their heads, you've maintained 1.8% and the world has come towards you. Luke, what did you see in the trend that told you that ultimately growth would end up where consensus is currently?
At the beginning of the year, when we had that 1.8% expectation, it was because we thought that consumers were front loading as late as the fourth quarter of last year, never really believing that consumers were that strong. Now we have moved to a call of recession with a probability of 55%. We made that call on April, I guess it's 4th, 2 days after the reciprocal tariff announcement. And I think what we've seen in that Q1 data is exactly what you were just talking about. You do have front loading. We see that from consumers in their purchases of durable goods. We don't expect that to continue. We see it from businesses. Mike just mentioned the strong CapEx numbers. Within that, you had a 60% annualized increase in business investing in computers and servers and whatnot. So you see that front loading there. And then, of course, there was the buildup of inventories. And I don't think that this should really make anybody feel that great about the first quarter. And of course, this data cuts off March 31st. It's right before the reciprocal announcement. And then one other point that I think is important, the domestic sales of domestic product. So the stuff that we make in this country and are either buying domestically or sending overseas declined 2.5% annualized in the first quarter. And that is the worst since the COVID shutdowns, and before that, the global financial crisis. So I don't think that the front running is going to keep going. I don't think it's going to be sustained. And I think that we're looking at a decline here in the second and third quarter.
Luke, has the damage already been done? That's the key question as some of the discussions around trade have softened.
I think a lot of the damage has been done. Of course, it could get worse and it could get better. But when businesses are dealing with significant historic uncertainty and start pulling back, either trimming around the edges with spending, pulling back on CapEx plans other than that front loading, then a lot of the damage has already been done. And we still have something like 60 days of these delayed tariffs, and that just creates a lot of uncertainty. And I think one of the most important things here, and you've been talking about the hard data and the labor market this morning, is that nobody should take any consolation in the April jobs number. The reference week for that data was April 6th to April 12th. So it's the week immediately following the reciprocal tariff announcements. So that means people who were paid that week, they were probably working the week before and that week. That's the 2-week pay period. So when we're looking at those job additions, it's basically people who had agreed to come in and start working maybe at the end of March and started working those last 2 weeks. Since then, we've seen the souring of sentiment, and we would expect to see damage in the labor market coming in the next report, not this previous one. I don't think anybody should take much solace in that.
Given the fact that there is the specter of some sort of job loss or some sort of deterioration in the labor market, Luke, how much do you look past the inflationary pressures that we're hearing about from companies and that Jonathan Pingle of UBS was saying he expects to see in the data as soon as next week?
Yeah, this is incredibly important. And I don't really think of those as inflationary pressures. I think of them as price pressures for imported goods, which is very different from inflation. The textbook of inflation is that you've got price pressures that go up and drive up consumer prices in a general manner. I don't think consumers are in a position to keep spending on services and driving up prices if the cost of imported goods is moving up so much. So whatever you get in price increases on the import side and from those physical goods, I think is going to take away because consumers are going to be pulling away from their spending on vacations, plane flights, trips to wherever, haircuts, all of that kind of stuff. And you're going to be seeing the weakness on that side. So in the aggregate, we would see some higher CPI readings and PCE readings in the early months. But that would give way in the face of economic weakness. And I really don't think that inflation is going to be a problem.
Luke, your call for a recession with a probability of 55%, does that take into account the reprieve we've seen on tariff rates since April 2nd?
Yeah, absolutely. If we have deals that are struck and everybody comes down and just stays basically at the 10% tariff that we have right now, and of course, we don't even have any idea what's going to happen with China, but let's say there are historic tariff cuts and they come down to something like 25%, let's say, you've still got a quintupling of the tariff rate that we had as of January 1. It's going to be between 12 and 15% or something like that. And that's not to say it's good, bad, or indifferent policy. What we're looking at is consumers that would struggle with those kind of price increases. Firms, if they believe that it's permanent, even at those lower numbers, 10% baseline, 25% on China, let's say, businesses have to change their operating structure. They have to change and make investments and really change their capital stack and their hiring decisions. And that kind of transition in a short amount of time is very disruptive. So even with the kind of trade deals that we haven't even seen yet, we're still going to go through a decent economic shock here. And the question really is how bad will it be?
Luke, when do you think that becomes apparent to the Federal Reserve, a hesitant Federal Reserve?
I think that the Federal Reserve knows everything that I'm saying right now, but they also need to watch to the upside for inflation. Of course, their biggest fears is inflation running up and going away. I mean, I don't think that they expect that it's going to run away. They recognize the weakness in the consumer, but they have to guard against that. They'll also know that the labor market would not have been showing in that previous report. But I think that given the possibility of the upside risks and that they can act quickly if they need to, that it'll become apparent to them, and then they'll start cutting whenever they see the weakness in the labor market, which is fine. But the labor market usually lags economic activity. We're going to see the decline in economic activity, and then you see the decline in the labor market later. So the Fed will be playing catch up at that point.
Hey, Luke, appreciate your time, sir. As always, Luke Tilley there of Wilmington Trust. Luke came into the year looking for weaker than expected growth, around 1.8%. The rest of the world came towards him. Then after the tariffs came on, started looking for a recession. But I think the way Luke sees the world, the way Neil Dutta sees the world, I think the important piece of this is that they saw the slowdown in process going into year-end last year and continuing through 2025. And that went against the grain of a lot of people looking for a boom off the back of this election we saw 6 months ago.
Yeah, they were still looking at a soft landing that was a landing, that was a deceleration that you were seeing in a lot of the data already. And it was off of a pretty high place. But that continuing with the added pressure potentially against growth that you're seeing from tariffs could be a more negative kind of look. I just wonder, given everything that he just said, why was his recession call only 55%, given that he didn't really sound particularly optimistic?
He didn't sound optimistic, and it was 55%, including the reprieve we're currently in. So that means if you figure even China coming down, not 60% with the president promised on the campaign trail, but something like 20, 25% and 10% tariff ring around the United States. He still thinks this can mean a recession. When you look at the likes of what Neil Dutta was saying at the back end of last year, how much did all of these tariffs and these high tariff rates accelerate that deceleration we're seeing in the economy?
If you're just joining us, welcome to the programme. Equity futures right now in the S&P lower, near session lows. We're down by around about 0.9%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. We start with a check on Marriott shares. Those are rising nearly 0.8% in the pre-market, despite the hotel company lowering estimates for a key measure of revenue growth. With that, it joins the ranks of peers like Hilton, Hyatt, and Wyndham. Still, Marriott cut its outlook by less than those rivals, indicating affluent travelers are less affected by economic uncertainty. Meanwhile, Kellogg delivered first quarter earnings that missed estimates. Shares are down more than 5.5%. Organic sales declined 5.6%, more than the 4.1% that analysts expected. The company also cut its annual sales outlook, pointing to broader weakness amid declining demand for cereal. And air traffic controllers at Newark International Airport lost radar and radio communication for over a minute on April 28th due to a technology failure. Sources telling Bloomberg multiple employees were placed on trauma leave after the incident, contributing to flight delays and cancellations. The FAA is working to address the issues. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. We'll get the view, the schedule, the agenda from Washington, D.C., and we'll talk about the markets with Oksana Aronov of JPMorgan. From New York, this is Bloomberg. The opening bell is about 44 minutes away, and we're near session lows. We're down by 0.9% on the S&P 500. With some morning movers for you, here's Danny Berger. Hey, Danny.
Hey, John. One of the worst performers on the S&P 500 pre-market this morning has been Palantir, down 8.5%. It had earnings after the bell yesterday. It raised expectations. It talked about ravenous demand for AI. But expectations for this company were so high. The best performer on the S&P year to date, up 63%. A little bit of disappointment as well that its rest of world of demand didn't live up to what the U.S. figures looked like. We also heard from Ford after the bell yesterday, another decliner in the pre-market. That is down 2%, or just a bit more than that. Ford scrapping their guidance for the year. Another automaker to do this, seeing a $1.5 billion hit to their earnings for the year. Not as bad as some others like GM. That figure was around $5 million. Jim Farley, the CEO, said that he wants to try to build more parts in the U.S., but said he has been communicating with the White House and has been very clear about the cost of the changes that will need to be made. Wrapping things up with another automaker for you, this time Tesla, down 2% in the pre-market. We got some sales figures from Europe, and they continue to look really, really poor. UK sales for last month fell 60% compared to a year ago. In the Nordics, that figure got high as 80%. That despite the fact that they had a new Model Y to put into the market, so that sending shares lower this morning, John.
Stock is down by about 2%. Danny, thank you. Appreciate it. Your calendar looks like this through the next 24 hours and into the weekend. Counting you down to the opening bell, your trading diary. As follows, at 10 a.m. Eastern Time, Treasury Secretary Scott Bessent testifying before the House Appropriations Committee at 11:30 a.m. President Trump meeting with Canadian Prime Minister Mark Carney. On Wednesday, Disney earnings, day 2 of Bessent's testimony on Capitol Hill, and a Fed rate decision and Chairman Powell news conference just around the corner as well. On Thursday, another round of claims and a Bank of England rate decision. Down in Washington, Tyler Kendall joins us now for more. Tyler, set up the day ahead for us all.
Yeah, hey, John. Well, perhaps one of the most important things on the agenda is this really high-stakes meeting between President Trump and the new Prime Minister of Canada, Mark Carney, considering that it appears very little progress has really been made when it comes to the trade talk front. And Mark Carney actually sort of lowered expectations, if you will, ahead of this meeting, saying he understands that this will be difficult but constructive talks. Of course, as you well know, the U.S. and Canada have one of the largest trading relationships in the world. data from Census Bureau shows that they exchanged about $916 billion worth of goods last year alone. Now, Mark Carney did outline sort of his strategy going into today, saying that he wants to move away from sector-specific talks to really looking at the comprehensive deal here when it comes to tariffs, because we have to keep in mind Canada has really been hit from all angles. That 25% levy on imports excluding USMCA compliant goods, the 10% levy on energy, but then also those sector-specific tariffs that really have been critical to this administration's push when it comes to reshoring on steel and aluminum and also autos. No doubt all of this will be on the table today. But Commerce Secretary Howard Lutnick yesterday, John, when asked if he was optimistic about the future of a deal, said that it's a really complex situation and that ultimately he thinks this is going to be a fascinating conversation.
Tyler, thank you. Appreciate the update. Tyler Kendall. Down in Washington, D.C., outside of the White House, joining us now, Oksana Aronov of JPMorgan. Oksana, good morning. Good to see you.
Good morning. Great to see you.
The bonds don't work. They just make things worse. Seems to be the takeaway from you and the team. Why?
No, bonds can work, but you have to know how to use them, right? And it is really important to understand the risks, and we can't just kind of go to duration as de-risking, which is what we used to do in prior cycles. And this is what we've been talking about, and I've been here talking about it for a while, which is that when inflation is alive and well, forget all the uncertainty that the administration has introduced, which has pushed up the long-term premium, but when inflation is alive and well, the Fed's hands are tied to deliver the kinds of cuts that we've seen in prior cutting cycles, even if the data softens some, which is what we're starting to see. And the Fed is really, really between the rock and a hard place, right? At what point do they get involved? They still have over $7 trillion on their balance sheet. Can someone please explain to me why that is? And what would happen if that money, if those holdings found their way to the market? So it is really important to understand what is driving that long end of the curve, because it has really been counterintuitive, I think, for many investors, right? With the Fed cutting cycle beginning, we've seen the long end actually move up. And if April was a poster child for anything, it was that bonds didn't save you. They just introduced more volatility into your portfolio.
There's a lot to unpack here, especially ahead of a 10-year auction today at 1 p.m. Eastern. How much do you discount the inflation that we are currently seeing as, and I don't want to say this, but I'm going to say this, transitory, since there is going to be some sort of deceleration in growth and a weakening in the overall economy that's going to pressure things on the other side?
So that really depends on your view on tariffs. And there is a difference of opinion there, right? So some people think it will not be inflationary because of what, Lisa, you're referring to, the slowing effects to the economy. Some people think it'll be a one-time shock. We actually believe that anytime inflation is in the conversation and tariffs are in the conversation, what is happening right now? Prices are going up, and manufacturers are still eating through the inventory that they have. They're not even really buying yet in large scale at these higher prices, right? But they're already anticipating that prices are going up. And so is it kind of a snowball effect that's going to continue? And I'm not saying we're going to sort of enter some sort of hyperinflation period, but it could just keep our inflation elevated in that 3% range. To give you a very simple example, we have a never-before-seen appetite for renting in this country because of home affordability or lack thereof, and yet we have less multifamily supply because it's been more expensive to construct, and it's going to be even more expensive to construct, right? So that part of the CPI alone is going to start trending up, the rents, right? And that's outside of anything that this administration is doing, because that's kind of a wild card. So I think inflation is going to continue to be at best sticky, at worst starting to head up. And I think that the conversation will increasingly move towards, is this a stagflation? How do we navigate this? And I think investors really, at the end of the day, the answer is never like, oh, we can't, just lay down and kind of nothing works. We are in the business of anticipating various scenarios, positioning portfolios for them. And the idea is to diversify sources of return, so you're not just relying on duration and falling interest rates, because zero rates are not walking through that door probably ever again, or not for a really long time, or possibly not in our lifetime.
When you look at the inflation outlook, though, so you're thinking it's more than just a one-time price fix. How much higher do you think we could actually see prices go?
So again, definitely not in the camp that we're going to see, a 9% type peak or a 7% type peak. But I think it's really important to recognize that even if inflation is stuck in that 3% range, right? Let's think back to the late 90s. And we've been pointing to that as kind of, for several years now saying that, look, you had a cutting cycle, but inflation was kind of circling around that 3% mark, slightly below, slightly above, and the Fed's hands were tied, and they maintained, Fed funds rate between 4.5% and 5.5% or something like that. And I think we're in that sort of churn where it's just going to be really hard to get it down to 2%, the inflation number, without a really meaningful recession. And I just, we don't see that in the cards right now.
Oksana, just to wrap it up, as you know, through much of April, it was difficult to find diversification between asset classes. The dollar, equities, bonds seem to trade in one bucket, at least US and dollar-denominated assets. How difficult is it to find diversification within the asset class, within bonds? And what advice are you offering people right now?
So that's a really interesting point, because when you look within the fixed income market, everything is highly correlated. So 5 years ago, your portfolio of different parts of fixed income had a correlation of 0.5 sort of within itself across the different things in there. Currently, that correlation is 0.9, above 0.9. So diversification is very hard to find. But April was a really exciting month, because if you are an investor with optionality, which is liquidity, we were working really hard and we're finding interesting things to do. Price really matters, because let's face it, bonds are not about price appreciation typically, right? Your high quality bonds are about income. I think people have forgotten that in the aftermath of the GFC. And now we're getting opportunities to actually benefit from price moves. They're just probably not at that 10-year part of the curve, because it's still inverted. And to bet on it to go lower is to bet on it to become more inverted. And I just don't think that that's a reasonable bet. So have optionality in your portfolio, introduce diversified sources of return, really engineer that diversification, which is really lacking in the markets within fixed income, between fixed income and equities, and be opportunistic, helicopter into areas of vol, which are plentiful and will continue to be plentiful. Take advantage of that.
Nice going into moments like April when you've got cash already. Not many people did. Oksana, thank you.
Thank you.
It's good to see you, as always. Oksana Aronov there of JPMorgan. A clinic on the bond market. Yields lower this morning, Lisa, particularly the front end of the curve. The 2-year down by 4 basis points as that 2-day Fed meeting gets underway.
You asked the right question. What does diversification mean? How do you do it within specific asset classes? And for a lot of people, it's been go out, buy a gold necklace, buy a gold ring, buy just gold, buy gold futures.
Bars of gold from Costco.
From Costco?
Something
you did
like
that, right?
I have not done that.
You've done that in the suitcase.
Stop trying to give people the impression that I'm carrying gold. That's a security issue.
When you see them in the airport, full of gold bars.
No gold. Coming up tomorrow, Julian Emmanuel of Evercore, Prime Minister of JPMorgan, former Kansas City Fed President Thomas Hoenig, Tom Porcelli of PGIM. From New York City, thank you for choosing Bloomberg TV. For our audience worldwide, this was Bloomberg Surveillance.